All right. So everyone in the class, are you all there? Welcome to this session on the complete revision of the chapter of fixed income securities, which is your securities valuation chapter. Yes. So in this video, we are going to cover all the concepts, right? And solve all the concepts will cover in great details and also solve practical question of each variety so that you are also comfortable on the application of those concepts, right? So this is going to be a full English video, but before I say more things, please confirm, are you people there? Is my audio there, video there? Is everything proper before we start? Come on. So very good morning, everyone. Very good morning. Who all do we have in this live class today? Please tell me. Come on, people. Who all do we have in this live class? Please tell me. Good morning. So let me also share my screen and tell you what this chapter is. Yes. So Monisha is there, good morning. Bhagya is there, good morning. Others in the class, very good morning. Joining quick. Everyone. Sir, what this chapter is? Let me show you. Let me show you. Sir, if you observe, there is no chapter named as fixed income securities in the institute's study material. That's correct. Then, sir, what are we doing in this chapter here? Sir, you have chapter number 5 of institute's study material called as securities valuation, right? This security valuation chapter tries to teach you the value, calculating the value of different securities, which all securities it primarily covers. It covers preference share, bond, money market, and equity. Cool. The security equity valuation. The thought process for this was exactly same as chapter number 13 of Institute's study material, which is business valuation chapter. So we have merged this two chapter and named it as equity and business valuation, right? For which the revision video has already been uploaded, right? And the other three chapters require same thought process, which is different from equity valuation. And these three securities have been merged as fixed income securities. The unique part of this chapter is that it being a small chapter, has so much variety of things to do that you will observe that in a small chapter, how can there be so many things to do? Every concept, right, has only one or two questions, meaning to say there are so many concepts that doing one, two question on each of the concepts make the chapter really big, right? So the chapter of fixed income security. But what is the best part? Despite having the variety, every concept is super logical, and if you give your best in this revision video, at the end of it, your feeling would really be, even if it has so many variety of things to do, overall my comfort is there. You will have a command over this chapter, a firm grip over this chapter, if you can watch this video with efforts, with your attention. Yes. So Divya, good morning. Everyone else in the class here, very good morning. Yes. So first thing is clear about this chapter. Next. This is just one particular video covering fixed income securities. There are other videos covering, say, mergers acquisition or covering derivative, forex, interest rate risk management, international financial management, portfolio, etc. For which the playlist has been given in the description below. You can watch all these chapters one by one. You can have a very strong command over the subject of AFM. Next, we are going to use two types of books in this video. First is the concept notes, right? The book that you see here on the screen are our concept notes. The best part about these concept notes is that everyone in the class, everyone in the class, cover all the concepts, not in a boring text form, rather in a interesting tabular form, diagram form, graph form, timeline form. All these things have been explained in this manner. For example, if I take you ahead, look at any particular thing. For example, this particular concept of M&A, right? Or M&A actually has primarily formulas which we learn with a very different approach. But say for any subject, let's say this chapter of fixed income security. So this chapter, people, the chapter that we have to do in the class today has a lot of timelines to learn. Every concept you will observe is explained on timeline, which make it easy for you to understand and extremely easy for you to revise and very effective retention. You will be able to retain it for a longer period of time. Second book that we are going to use here in this class today is the question bank. This complete question bank, which has a compilation of RTPs, MTPs, exam paper, study material, practice manual, board of study, knowledge portal, everything has all the questions that you need. All right. And every question, if you observe, has a QR code. Meaning to say, when you scan the QR code of this question, you can watch the video solution of that particular question whenever you want, as many times as you want. So that's about the question bank. Now the point is, these two books are freely available for you people to download. These are the same books that we give in a printed form to a regular batch student, right? Any batch student, in fact. The same books you can freely download. The latest OutScanner that you is right now available is all updated till Jan 26 exam, which is applicable for May 26. All right. Now my point to you is, sir, if you want, you can also buy hard copy of the OutScanner, right? Which is a printed version of the same PDF. Only difference is when you buy the hard copy, access to the QR code is there with you. You automatically get a free access. You don't have to pay additional for it. Soft copy people cannot get QR code access due to some technical reasons because of whatever has to happen in the backend, right? But now, sir, link for everything that I said is there in the description. Now I'm telling you the last thing, which is for the attempt of Jan 26, I have given you a ABC analysis. It is a question-wise ABC analysis. We don't say entire chapter of Forex is C category or entire derivative is A category. What do we rather say? Some question of Forex is A category, some question C category. Similarly, some question of derivative is A, but it also has C. So overall, making your efforts more productive. Ultimately, you don't have to feel like that I skipped this entire chapter, right? Or I kept this chapter as a last priority, which I could not do only. And in the exam, you get to see the question of, say, 15 to 20 marks from that chapter. No. Every chapter you have a comfort, you have a confidence. So this ABC analysis has been shared. Sir, in this entire PDF, I have marked the questions one by one to be of category A with green color, whether it is LD or if it is LDR. Category B is red marking, category C has no marking. And if the question has ambiguity, that has been marked like this. You can download this PDF where ABC has been marked, again, absolutely free of cost. In this video, we are going to solve primarily category A questions, which is your LDRs, along with the concept that we learned. So if the background is ready, that what are we going to do in this video, then are we all ready to start? Shall we all proceed? Come on, everyone. Are we all ready? Shall we proceed with this super interesting chapter of fixed income securities? And before we start, to all the live people watching me right now and to all the recorded people, guys, a gentle reminder that if you ask who cracks the CA exam, it is not the one who's the most intelligent kid in the exam hall. Who cracks the CA final exam? It is not the most intelligent kid in the exam hall. It was the most determined and disciplined kid in that exam hall. So when you hear when I'm teaching, I'm not expecting your intelligence. I'm expecting your efforts, your determination, your discipline. When you watch it, try to make sure you watch it in a single go, right? And let me know that by the end of this revision video in the comment section that sir, yes, I did watch it. All right. And then you will have a sense of satisfaction that I've given my efforts and this video is now going to, this video has now made the chapter really easy for me. Yes, like people. So let's get started. Sir, this chapter of fixed income securities, in this we will primarily have two types of securities. Which two? First, capital market fixed income security and money market. The security having a life of 1 year or more, like share, bond, etc., are capital market. Whereas the securities having a life of less than 1 year, like treasury bill, like money market instrument, like commercial papers, right? All that are covered under money market. Both of these things we will have to learn, right? In capital market, we don't have to do shares because that's done in equity valuation. We will now talk about bonds. So let's look at the first section, the basic of bond. Just like every other revision video, we need to, in this video, people in the class, make sure that the basics are really strong. I will a lot of time come to this particular chart again and again while explaining other concepts. So please pay attention to what I explain in the basic. Sir, this is a company or this can be a government who is in the requirement of fund. If it requires fund, it can go to the bank and borrow it. Similarly, it can go to the public and borrow from them. But how can you borrow from public? By issuing bonds to them. So issue of a bond is actually a kind of borrowing. So when you issue the bond to the public in general buys your bond, subscribe your bond and pay you an amount called as issue price. How much of an amount do they pay you? They call it as issue price, which means that this is the price at which your bond was issued. Agreed, sir. This is the amount of borrowing this the company has issued, right? Has made. This person, particularly people in the class, is called as issuer. What is this person particularly called as issuer? And what does this person particularly called as? You can call him to be an investor or a bondholder. Sir, every bond that is issued is a kind of borrowing case. So borrowings come to you with the interest rate. That interest rate is effectively called as coupon rate. It comes to you with the deadline, which means the maturity date by the end of which the borrowings has to be repaid. And it comes to you with the face value. So on the face of every bond, the value is returned, say 1000 rupee, that becomes its face value. Sir, what is the relevance of face value? I will explain. When you borrow from someone, you have to make the interest payment at the end of every period. How much is that interest amount, right? Which is officially called as coupon amount. What do you officially call it? Coupon amount. So that coupon amount, how do you calculate? It is calculated using face value. So on the bond, we have a face value, and on it is also written a coupon rate. So face value multiplied by the coupon rate, which is a kind of interest rate, gives you the amount of interest, the amount of coupon which is to be paid at the end of every period. How long will you pay it? Till the bond gets repaid, till the borrowing gets repaid. So if you borrow here and if you repay here, at the time of repayment, what transactions will happen? Exactly opposite. Today, the investor paid the amount and received the bond. Now will happen otherwise. The issuer will pay back the amount back to the bondholder, and bondholder will surrender that bond to the company. Will give that bond back to the company. That's how people in the class the transaction is, which means the amount which gets repaid is officially called as redemption value. The price at which the bond got redeemed, the price at which the repayment happened is the redemption value. With this entire story, you'll have to understand a lot of things. First, all the terminologies. Second, the entire mechanism. And third, especially the inflow and outflow of cash. So as a bondholder, it was an outflow of 0 rupees from your pocket equal to the amount of issue price. And then at the end of every period, you received the coupons. And on maturity, you received the redemption value. Right? Now taking you all ahead. Sir, the issue price, once the bond is issued, the bond gets listed in the market and the investors and the trader in the market can buy and sell that bond at whatever be the CMP. It may with the time increase, it may with time decrease. The CMP may change and ultimately the bond is redeemed at its redemption value. Sir, is it compulsory that when a bond is issued, it is issued equal to its face value? The answer is no. It can be issued at a price higher than face value. The face value is 1000, it can be issued at 1100, calling it to be issued at premium. Similarly, it may be issued at 1000, calling it to be issued at face value at par, or it may be issued at 900, which means issued at discount. Yes. Similarly, a bond can trade in the market at premium par or discount. Similarly, a bond can be redeemed at premium par or discount, which means all three things relate to premium par and discount. Agreed, sir. Aligned, sir. Sir, when a bond is issued today, we have a maturity that we already know. It is called as original maturity. Agreed. But sir? Suppose I purchased the bond 1 year back. Now I stand at the end of first year and I want to check how much is the time left to maturity now, called as officially called as time to maturity or officially called as tenor. So in this situation, the tenor is 2 years. Correct? So what all have you learned? Thus just summarizing to you. First of all, the terminologies you have learned: issue price, redemption value, coupon amount. You have learned issuer, bondholder, face value, coupon amount, maturity. You have learned original maturity, time to maturity. You have learned about the inflows and outflows at the time of issue of the bond and redemption of the bond till this part. And you have also learned about CMP and premium par and discount. How much out of 10 till this point that I've explained everyone in the class about the basics of the bond? Come on, come on, come on, come on. Requesting your responses. Every single student sitting in the class, if you got the basic, you need to hit everyone in the class the like button. People, there, basics sorted. Also, let me tell you, by the end of this video, right? Wherever you feel that the video has really helped you out, you need to tell me in the comment section how was your experience with the video, why. It motivates me, most important for me to come up with this video is really important, right? Especially in full English language. Let me tell you why. When I take an English video, there are at least 50 students like. Cool. Where I take an English video, the strength is relatively less, which become hard for me to get motivated to come here. So at least through these comment section, you can let me know, and I know that ultimately students are watching it. It was not the waste of my efforts. It has helped you out, right? The first thing. Second, any new watcher that comes to this video, through your comments, he gets to know that what this video will be about, right? Is it worth to give try to this video or not? So that is something you'll have to surely do for me. So Manisha, Bhagya, are you all till this point 10 on 10? Let us walk proceed ahead. Perfect. Sir, all these things have been explained here. Now I will tell you one more thing. If the examiner is silent, then the redemption value is to be assumed as face value. What is the price at which bond will be redeemed? It will be equal to face value. The very next thing, which is a point of utmost conceptual clarity, you need to learn are the types of bond in this chapter. We need to observe if the bond given to us in a question is a zero coupon bond called as deep discount bond, or it is a coupon bearing bond also called as conventional bond, or it is perpetual or redeemable bond, or amortized bond. Sir, what is a zero coupon bond? The name itself says there won't be any coupon. A bond is issued at 0 point at its issue price. The bond is redeemed on maturity surely as it's at its face value, which means no amount of coupon paid to the investor, the bondholder in between. So from the perspective of bondholder, this is the initial outflow of issue price and ultimate one inflow of redemption value he will have on maturity after 5 years. So as a bondholder, will you be ready to pay an amount for the bond which won't pay you coupon? The answer is not no. The answer is yes. You are ready to pay a price, but that will be a highly discounted price. That will be a deeply discounted price. If the face value is 1,000, you won't pay 990 or 950. You will just pay, for example, 600 rupees. So that you know that after 5 years, when I receive my value back, right? After 5 years, when I receive that cash flow back, that cash flow I should receive with the due amount of interest which was getting accrued over a period of 5 years at the return which I require to earn. Correct? It should be along with the due interest, due return that I deserve to earn because I have invested in that security, that is deep discount bond. Next, and you don't have to get technical to it. I will over the time explain more things about it. At this point, our focus is to just identify the types of bond and associated cash flows. The most important is associated cash flow. If it is coupon bearing bond boss, right, then it is such a bond where what if you subscribe the bond today, you will receive the amounts of coupon at the end of every period, and you will also receive the redemption value. Sir, when you say the amount of coupon at the end of every period, is it that the coupon is paid annually? No. The rate of coupon, if it is 8%, it is always per annum, that is for sure. The coupon rate is always per annum. But that coupon can be paid annually. Suppose face value is 1,000 into 8% is 80 rupee. So coupon may be paid 80 rupee once in a year. Or if the bond is semi-annual, then coupon will be 40 rupee at the end of every 6 months. If it is quarterly, then it is 20 rupee at the end of every quarter. So that's how the coupons are paid periodically, and at the end of a such redemption value, this is coupon very important. Cool. Then is irredeemable or perpetual bond, the bond which does not have a redemption date already decided. Which means right now a bond is assumed to be have a life of infinite years. Which means when a bond is issued at 0 point at its issue price, since there is no redemption, which means till infinity the bondholder will continue to receive the coupons and coupons and coupons at the end of every period, right? Without any redemption amount being received. That is a irredeemable bond. Then is amortized bond, which we are not discussing in this revision video because no question ever has been asked on this concept of amortized bond, particularly of fixed income securities chapter. Cool. So that's not needed. Next, people in the class. So how do we identify in the exam which type of bond it is? Observe that zero coupon bond is something which has a maturity date, but not a coupon amount. When you see this, you realize that is a zero coupon bond. Similarly, if it is a perpetual bond, there will be a coupon amount, but no maturity date. So no maturity date given in the question, which means it is a perpetual bond. And the last one, everyone in the class, is coupon bearing bond, which means the bond which will continue to have the amount of coupons till maturity, and it will also have a maturity date. That is my conventional bond. That is what you need to identify in the exam. Sir, what this chapter will have first? The first two things I will explain. Just like how you have learned to value the share value, the share today, value of share today. Similarly, we will try to find out the value of a bond, right? The first thing to learn. Let's start with it, in fact. Do you people remember in the chapter of equity business valuation, I give you a fundamental principle of valuation? Yes or no? The fundamental principle of valuation which says value of a bond today. Value of a bond today is the present value of future cash flow that it gives you. Similar to a value of a share today is the present value of future cash flow that the share gives you. Similarly, the present value of future cash flow from the bond is the value of bond today. Sir, what are the future cash flows? That actually depends on the nature of bond. If the bond is zero coupon bond, future cash flow is this. If a bond is a coupon bearing bond, future cash flow involves coupon and redemption value. If it is a irredeemable bond, then the future cash flows will be coupon. So present value of all these future cash flow today is the value of the bond. Here the value of the bond is present value of redemption value. Here the value of the bond will be present value of coupon and redemption value. Here the value of the bond will be present value of those infinite coupon today. But the question is, when you do the present value, you need a discounting rate, right? If you imagine the basics of AFM that I've taught you in the equity and business valuation chapter, the basic, and I'm repeating it here. It's not that if you've not watched that particular video, then you cannot watch it, right? I will repeat the concept that has already been taught. The concept says that the cash flows are always discounted using a discounting rate. Obviously, sir. The discounting rate for any cash flow is nothing but the required rate of return from that particular asset. If an asset is the equity share, then required rate of return of equity share become the discounting rate for cash flows of equity. Similarly, the required rate of return become here the the discounting rate here become the required rate of return from these cash flows related to the bond, right? And the required rate of return, people, please remember, depends on the risk you take. The more risk is there, more is the required return you need, which is why equity, which has higher risk, has higher discounting rate. Bond, which has a lower risk, has lower discounting rate. Correct. So we will learn more about the discounting rate, but this was the basic people in the class on valuation that you had to learn, right? So if you try to imagine it with the basic concepts of time value of money, let me teach you something very important. Do you agree present value plus interest become future value? Present value, which means the amount that I have today. Future value means amount I will pay or receive on a future date. And the link between the present value and the future value is the rate of interest. Agreed, sir. Sir, present value plus interest is future value for sure. But from the future value, if I eliminate the amount of interest or the component of interest, do I get the present value? Yes. That is what exactly discounting is. Imagine a bond where you have the future coupons and or redemption value. If you have the coupons or redemption value of the future that you are going to receive on a bond, when you discount those future cash flows with your required rate of return, you get the value of the bond today called as intrinsic value of the bond. So if you have the future cash flow, you discount it, which means you eliminate the interest from the future value, and what you get is the present value, which is the intrinsic value of the bond. Do you understand, people in the class? Are you all able to connect to whatever I've been speaking? Kindly respond to me on this. Come on, people. Come on. Who all are watching to me live right now? Tell me. Monisha, there. Bhagya, there. Who else is live? Come on, everyone. Yes. Shall we all proceed? Everyone in the class. Perfect. So, sir, the required rate of return, sir, for equity, the required rate of return is cost of equity, which we can calculate using CAPM. But for this bond, what is the required rate of return? Sir, required rate of return is a very simple common sense. It is based on the concept of opportunity cost. In the market, there is some other bond. All right, sir. On that other bond, suppose the rate of return which I can earn is 15%, and that other bond has the same risk as my bond. So in that case, do you agree that from there, if you can get 15%, then the return that you would want to earn from our particular bond is also 15%. So required rate of return is the amount you could earn by investing in similar bond in the market, is the required rate of return. Using that required rate of return, if you discount the future cash flow, you get the amount of the bond as its present value, which is its intrinsic value. But sir, why are you valuing the bond? The bond price is already there in the market. Then what are you calculating? Nilesh, very good morning. Are you going to be live now throughout the session? Point everyone in the class is, if the intrinsic value, what you calculate is the intrinsic value, which is what should be the value of the bond, and what is there in the market is its current market price, which is what is the value actually there, right? So value actually there is called as CMP or issue price, which means at this point, if I stand, then the price that actually exists in the market is issue price. But whereas if I extend at this point, the price that actually exists in the market is CMP, which is why I will interchangeably use the word issue price and CMP. You will have to understand at your own that what is my context. Could you understand my point? Context is at 0 point, if I do the valuation, I'll calculate the issue price. On a later date, if I do the valuation, I'll calculate the CMP. But sir, what I actually calculate is frankly the intrinsic value. These are the actual prices. Is it important that the fair and actual prices are same? No, sir, they can be different. If they are different, then comparing the two things can help me to understand under overvaluation. We can compare the intrinsic value with CMP, comment on the CMP, and figure out if the bond is undervalued or overvalued or fairly valued. For example, what do you mean to say? Suppose the bond price on the market, the CMP, ignore this. The bond price on the market, which is CMP, is more than the intrinsic value, which means the value is more than how much it should be. Then we can say the bond is overvalued, and in that case, we should sell the bond, right? Sir, don't get confused between comparing CMP with its face value. Face value comparison does not tell you over under valuation, it tells you the premium discount, which is a different thing, which has got no relation with this decision making of buy sell. Are you all able to differentiate the point that I particularly tried to explain? Current market price less than face value is discount. That does not mean undervaluation. Hello, boss. If I would be an examiner, I would surely make this MCQ that a bond is trading less than its face value. Can we say the bond is undervalued and we should buy it? Simple. For example, true or false? Never. Discount is not undervaluation. Discount simply means it's trading less than face value. With this particular point, which is a point of exam, could you process a point of conceptual clarity? Could you process that if CMP everyone in the class is less than its intrinsic value? Imagine CMP is 900 and intrinsic value, the value that I want, says it should be 950, or CMP is 1100, which is premium, but intrinsic value is 1150. So we will say value should be 1150, but it is 1100 less than its intrinsic value. If CMP is, then the bond is undervalued, and we should, in that case, buy the bond, and in the third case, we should hold the bond. So that's how we did the valuation, and that's how we realized that the use of comparing intrinsic and CMP is people in the class under overvaluation. Cool. Sir, this is going to be the first section of our learning. Now let me tell you, or let's do the first section. Let's take this ahead. Sir, with this example, do you understand? The required rate of return and the intrinsic value will have inverse relationship. When my discounting rate, which is the required rate of return, increases, automatically the present value, which is its intrinsic value, falls. And if the required rate of return falls, the present value, which means the intrinsic value, increases, right? Getting my point, people? And that's why people in the class, that relationship you will have to remember, which will be of use in the practical question, if any, right? Now let me tell you the calculating the intrinsic value of different kind of bond. And here I will tell you a point of clarity. Sir, if I assume the bond to be fairly valued, which means can I say its price in the market is same as its intrinsic value? And with this assumption of fair valuation, everyone, the examiner can interchangeably use the word intrinsic value, issue price, or CMP with this value, with this word of fair valuation assumption. Now let me explain to you in this one more thing before I proceed ahead to the main concept. Sir, suppose the value according to me was supposed to be 950, but actual price in the market is 900. When you go to the market, how much is the price at which you will be able to purchase the bond? Everyone in the class, please participate. Intrinsic value of 950 or actual market price of 900. When you go to the market to buy the bond, what is the price at which you'll be able to purchase it? So obviously, this value is in my notebook. The actual price that prevails in the market is 900. So now you have to answer my question. Surrounding voice are you? Hold on for a minute. The mic you're saying is not very well attached. So boss, this was really surprising. You could have told me. I didn't check it. I didn't check it. Alpha, thank you so much for letting me know. What was the name you said in the last lecture? I missed your name. Sorry. Everyone else, now I guess the voice has to be far much better. Nilesh, Monisha, Bhagya. Is it that you could not feel that gap of voice being not? Do you feel there's a difference now in the voice? Come on. बताया नहीं था नाम तो अभी बता दो भाई. Is my voice different now or the same? It's more clearer? Good to you. So everyone, back to it. You all realize that we will have to, people in the class, right? We will have to purchase the bond at 900. So now my question to you is, present value, interest and future value, out of the three things, if you have any two, can you find the third one? Obviously yes. For example, sir, future value is given to me. If I had the interest rate, which means my discounting rate, I calculated the present value called as intrinsic value. So if you have this time the present value at which you purchase the bond, which is at CMP, if you purchase the bond at its CMP, and if you have the future value always there with you, do you agree future value includes coupon and redemption value? And that is something you would always know. because they are fixed, they are certain, which is why the chapter, sorry, they are not certain, but they are fixed today, which is why the chapter is called as fixed income securities, because future cash flows are fixed. So if you know the present value at which you invest, if you know the future cash flows that you will receive, can you not back calculate? How do you back calculate? I'm not asking, but somehow do you agree we can back calculate the amount of interest, the rate of return, the rate of return that which we would be able to earn through this investment? Requesting your responses. I'll repeat that. Live people, I'll just check your comment. Give me a second. Hello. I'll just check it. Live people, your comments. Just give me a second. But do you all, every single student sitting in the class, realize that if you have the future cash flow and the interest rate, you can find the intrinsic value. Similarly, if you have the CMP and the future cash flows, obviously, can you not calculate the rate of return that you'll be able to earn on this investment, the interest rate? The answer is yes. The first part of the chapter is called as valuation of the bond. The second part of this chapter, which is this one, is called as yield calculation, calculating the YTM of a bond. And you know what? Now, if I assume the security to be fairly valued, if I assume the intrinsic value to be equal to CMP, then if the present value is same, then obviously the rates of interest have to be same, because the future value is always same. The future cash flows are always same, which means in that case the required rate of return and YTM will also be same. Yes, and now I'm speaking the most important line. The most important line, people in the class, is if the listen to me, if the security is assumed to be fairly valued, then intrinsic value and CMPN or issue price are the same, RRR and YTM are the same, and examiner may use this word interchangeably. It may happen that it give you YTM and ask for CMP. It may happen that it give you required rate of return and ask for CMP. It may happen that it may give you YTM and ask for intrinsic value. Any combination is possible. You have to just understand, if the rate is given, you should be able to compute present value, and if the present value is given, you should be able to compute the rate with whatever name, because future cash flows you will always know. How much out of 10 to the concept that I've just explained now? Now we will enter into these individual concepts one by one. First is valuation, second is YTM calculation. So give me a second. हाँ जी, श्रुति सिंह सर, आप पोर्टफोलियो का रिवीजन में आपने बताया कि आप एक वीडियो डालोगे, कब रिटर्न ऑन पोर्टफोलियो को रिटर्न ऑफ मार्केट अज्यूम किया है, आईसीआई कब बॉन्ड की वैल्यू दी है इन द क्वेश्चन? कौन सा वाला भाई? ओ, गॉट योर पॉइंट श्रुति. सो थैंक यू सो मच. वो चीज मैं भूल गया था करना. मैं ये चीज नोट कर लेता हूँ, बिकॉज आई हैव टू डू इट. ठीक है, आप एक व्हाट्सएप डाल दो ना प्लीज. गॉट इट श्रुति, डन. क्या बोल रहे हो सर? व्हाट्स द डिफरेंस बिटवीन डिस्काउंटिंग रेट एंड आईआरआर? डिस्काउंटिंग रेट आईआरआर में कोई लिंकेज ही नहीं है. सॉरी, let me do that in English. Discounting rate and IRR has got no linkage. How can they be different? IRR, people in the class, is the rate of return that you'll be able to earn when you make any investment. So similarly, YTM is considered as the IRR of the bond, which means that when I make this investment in a bond at its CMP or intrinsic value, what is that annualized rate of return that I'll be able to earn? Is its YTM. Cool. But discounting rate of return is not the rate of return you will be able to earn, is rather the rate of return that you want to earn. One is your mindset. One is your mindset. Required rate of return is your mindset of how much do you want to earn. And this is the reality of how much you will be able to earn, is the difference. YTM is IRR. Cool. Sir, now taking you to the valuation. So now you know that these words may be interchangeably used. Hello? These words may be interchangeably used. Monisha, you're 10 out of 10. Alpha Mighty, bhai, what's your name? Very good morning. Shifa, are you there now throughout the session? Bhagya, settled with it? Alpha settled. Perfect, everyone. There, shall we continue? So great life, people. Your strength is increasing. I like it. Thank you so much. Right. So now, everyone in the class, point is, so For valuation, we need the present value of future cash flows. That's given, right? Sir, if it is a zero coupon bond, what is the future cash flow? Only one thing, which is its redemption value, which is always equal to face value. How do you calculate the present value of a future cash flow? Simply 1 plus r to the power n. If you divide it with, you get the present value. The discounting rate R in our case right now is YTM. You can also call it RRR, doesn't matter. You can interchangeably use this word. So 1 plus R to the power n, 1 plus YTM to the power n. The question is, what is your n now? The n is the time period till the future value or that redemption value is received. Sir, if the bond is valued here, the redemption value is to be received after 3 years. However, if you want value the bond here, the redemption value is to be received after 2 years, and in that case n become 2, which means what matters to me for the purpose of valuation is time to maturity, which is why if you observe n in our discussion is time to maturity and not the original maturity. Yes. So fine, sir. 1 plus r to the 1 plus ytm to the power n is valuation. Similarly, if it is conventional bond, then we have to discount the coupons and the redemption value. There are two ways to do it. One is really simple. If you have the coupons of every year, which is the same amount, you can assume it to be the annuity. So coupon multiplied by the present value annuity factor plus the redemption value to be received at the end multiplied by present value factor will give you the present value of the bond today, intrinsic value today. Now, for the purpose of discounting, the present value or present value annuity factor is to be calculated at the rate of YTM for respective number of periods. Fine, sir. Next, everyone in the class is another way of looking at it. If the amount of coupon is same every year, you use this formula. If the amount of coupons is not same every year, then you will have to discount each of the coupons manually. So coupon of first year is to be discounted using the present value factor of first year, which is divided by 1 plus YTM to the power 1. Then second year coupon is to be discounted using 1 plus YTM to the power 2. Similarly, the last coupon is to be discounted using 1 plus YTM to the power n, and the redemption value is to be discounted like this. This was the another one. Now you are realize, when I started my basics, I said let's first identify in a given question the type of bond, because accordingly my formula and my mindset gets decided. The third people in the class is the perpetual bond, which is if the amount of coupon till infinity continue to gets received, how do you discount all those things? So it is the concept of perpetuity. When the same amount till forever you receive, it is perpetuity, and the present value of perpetuity is A by R. A being the amount of annuity, R being the discounting rate. In our case, the annuity amount is coupon you will receive till infinity, and discounting rate is YTM. So coupon divided by YTM is the intrinsic value at 0 point. For amortized bond, we don't have to do this discussion. The first three bond is what gets tested in the exam. Requesting every single student sitting in the class, are you people 10 on 10 settled to what I said? Come on. Are you people please 10 on 10 settled to what I said? If you say yes, I'll immediately take you to the practical question, and that is when you will feel the application of what you have learned. Yes. So perfect, sir. Let's go to a practical question. Let's go to this LDR ABC analysis file, and I have a disclaimer to make. This video which is getting recorded right now is valid at least for the next 1 year, at least I'm saying, right? Suppose you watch this video in September 26 attempt. This file that you're seeing on the screen right now is for May 26 attempt. Now, when you watch this video and go to the download section and download the file, you will get the latest file updated for September 26. Or if you buy the hard copy, you will get the latest September 26 hard copy. So it may happen that the sequence of question may turn out to be slightly here and there, which should not be a problem to you. The books you have got is latest. The lecture that you are watching is fully applicable. It may happen that I am showing you this to be question number 2 while solving, but you see it as question number 3 in your book, which is all fine. You should be able to match the question. A sequence of 1 or 2 questions here and there is fine. Sir, let me go to the chapter of fixed income security, which in my book right now is page number 139. Come on. Let me figure out the first question we will do. Hold on for a minute. So let's do the first question to be question number 4. Very easy, very simple question. It is just to give you a comfort of what this chapter is, right? What this concept is. Akfa industry planning to issue a debenture. Sir, the face value of the bond is 1000. So if the question is silent, that become my redemption value. The term to maturity right now is 10 years remaining for maturity. Coupon for the first 4 year will be 9%, then 5, 6, 7, 8, next 4 year being 10%, and last 2 years it being 14%, which means the amount of coupon will change every year. Yes. On the timeline, can you imagine the future cash flow? Right? Face value into 9% is 9 rupee for the next 4 year, then 10 rupee for the next 4 year, then 14 rupee for the last 2 years. And value of the bond is the present value of all these future cash flows. Since the amount of coupon is different every year, I cannot apply annuity concept and I'll have to discount all of them. Agreed? Yes, sir. So for the next people in the class, 10 years, if you have the amount of coupon ready, I'll say the current market price on the similar debenture is 15% per annum, the current market rate. On the other bond, if I invest, I get to earn 15%. So similarly, what I require to earn from my particular bond is 15%. The company proposes to issue the bond such a manner that it can yield 16% compounded rate of return. Although what ideally I should require is 15%, but company says that let's value the bond such that an investor is able to earn 16%, which means the company wants an investor to earn 16%. So what should the issue price accordingly be? Sir, only when I discount these future cash flow using 16%, then I get an issue price at which if an investor invests, then he is able to earn 16%, right? Common sense. If the discounting rate is 16, then only you get such a present value, that at that present value, if you invest, you earn back 16% only. There are three parameters: present value, interest, future value. Any two if you have, you can find the third one. So this time they want your rate to be earned as 16, so therefore the present value accordingly should be discounted using 16%. Sir, company also proposes to redeem at 5% premium, which means redemption value will be 105. Determine issue price. Let's observe a standard format of presentation as well. What's the standard format of presentation, people in the class? For the next 10 years, what are the cash flows you will have? First 4 year 9 rupee, then 4 year 10, then 2 year 14, and at the end is 105. At the rate of 16%, if I use the present value factors that are here, for last two low, present value factor will be same because both of them are 10 years. Then you multiply coupon with the present value factor to get DCF, and sum of that is the issue price of the bond, which is present value of future cash flows. We have not done the math in the class. The main focus was to explain the amount of coupons. The main focus to explain choosing 16% over 15%. The main focus was to explain the present value of future cash flow and to be able to interpret the question. How much out of 10 on question number 4, people in the class? Please participate on the simple question. Are you people 100% settled? Come on. Next question that we gonna do in the class is question number 8. But before doing question number 8, I will need to explain to you the concept of yield. The concept of yield. And that I will explain. Let's first do part A of this question. We have done the valuation of one type of bond, which was so far the coupon bearing bond. Everyone said 10 out of 10. So Manisha, Shrifa, Nilesh, Bhagya, everyone, thank you so much for responding. Your responses keep me going. Right? So personal thanks for this. Just give me a second, guys. Just give me a second. Cool. I've tried to make the screen look bigger to you. Fine. Perfect, people. So what were you saying? I was saying that, people in the class. Sir, question number 8. The question we have done previously, which was question number whatever, 4th, was a coupon bearing bond, conventional bond. Now let's solve a question for which you will have to identify what kind of bond that is. Sir, calculation of market price says there's this 10% government of India security currently quoted at rupee 110. Sir, Determine the market price of Government of India security, which is 10% coupon rate. When they say 10% bond, 10% is the coupon rate, which is currently quoted at rupee 110. So if the price is already there, what do I calculate? But the yield is expected to go up by 1%. So what they are showing, that if the yield, the YTM, the discounting rate goes up by 1%, then what will be the market price? But sir, we have not been given the present discounting rate or the present yield. How do I calculate the increased discounting rate? For that, I first need the present discounting rate. Now. But the question is, which kind of bond, people in the class, you think it is? Accordingly, I will guide you. Please tell me which kind of bond do you think, people in the class, this is? And accordingly, we'll proceed. Give me a minute. Let me have water. Come on, people. What kind of bond, everyone? Could you not even identify what's happening? Then what is the point of making all these efforts? Sir, there was a simple way to identify. If there is a coupon rate, can this be a zero coupon bond? Everyone in the class think. If it is a, if there is a coupon rate, can it be a zero coupon bond? Oh, your chats were stuck actually. Now I see your chats. One second, huh? One second. Now I see your chats. Oh, you've responded. Cool. Thank you so much. So I say, since there is a coupon rate, can there be a zero coupon bond? No. Is there a maturity date you can see in this entire question? No, which obviously means it is a, everyone in the class, irredeemable. It is a perpetual bond. So let's do it. We say, sir, for a perpetual bond, right? They are trying to say that if YTM increases by 1%, then how much will the price be? So we are like, how much is the YTM now? So if the future cash flows, which means the coupons till infinity are there, and if you have the current market price already there with you, can you please find out the present YTM? Yes. Then you increase the YTM by 1%, and using that, then you find out the revised price. So that simple as the question. In the same question, you have to first learn to calculate the YTM, and then you have to learn to calculate the you have to first calculate the present YTM using current market price, and then revise that YTM, and using that revised YTM calculate the revised market price. Simple. Sir, for a perpetual bond, particularly if present value is coupon divided by YTM, can I modify this formula to say YTM simply will be coupon divided by its present value, which is either CMP or intrinsic value or issue price, whatever you call it. But YTM, everyone, will be coupon divided by this present value. So sir, if the amount of coupon is 10%, that is the rate of coupon. What is the amount? In the absence of information, what is the best assumption of face value? 100 rupee, because price is 110. The value in that case is supposed to be around 100 only. So 100 multiplied by 10% give me rupee 10 is the amount of coupon. So 10 divided by the current market price of 110 give me YTM of 10 divided by 110 give me 9.09% being the YTM. And if that YTM increases by 1%, I get the YTM of 10.09%. And now, if the coupon of 10 gets divided by 10.09% YTM, hello, hello. If the coupon of 10 gets divided with the YTM of 10.09%, which is that increased YTM, then I get the decreased value of price, which is so 10 divided by 10.09% is 99.11% will be the revised MPS. Pankaj says, good morning, sir. I'm here for the 1 second to hit the like button on your video. Thank you so much, Pankaj. Thanks. Are the studies going on well? Are you settled? Are the revision videos helping you out now that we did last month? Please tell me. Sir, this one is clear. The first part of this question is clear. Sir, now in the second part, which is again really interesting, what it says, let's learn. People in the class, please focus. Sir, in this question, in this concept that we have learned, is it necessary that coupon has to be an annual payment? No. Coupon amounts may also be semi-annual or quarterly. And if that is the case, how does the valuation get affected? Please everyone in the class participate. Sir, please learn. Please pay attention. The coupons that you take here are not the annual coupons, it is the coupon per period. Which means if the company distributes coupon in every 6 months, I have to take the coupon of 6 months, not the coupon of per year, right? It is the coupon per period. Sir, YTM here is not YTM per annum. It is the YTM per period. Imagine that YTM given in the question is 10%, then obviously it is 10% per annum. Agreed, sir. But if the coupon period is 6 months, every 6 months if the coupon gets paid, then for that period of 6 months, how much become the YTM? People in the class, 5%. So YTM to be used for the present value factor is going to be 5%, right? Which is the YTM per period. And N does not mean number of year, N means the number of periods. Imagine the bond had a life of 3 years. But in a period of 3 years, there would be how many such 6 monthly period? Sir, in a year there will be 2 period. So in 3 years there will be total 6 such period. So N will become 6. Meaning to say, when you have to value a bond, coupon is coupon per period, YTM is YTM per period, and time to maturity is number of periods. These things are periodic, not annual. And that is what you have to particularly use in the question that we do now. The point of learning in this question is that only. There is a bond with 7.5% coupon rate, face value 10,000, time to maturity 2 year, yielding 6%, needless to mention, per annum, but the interest is paid half yearly. People in the class, interest is paid half yearly. Can you please participate that my one period is of 6 months? So in a period of 2 years, how many there will be such coupon period? There will be 4. So N become 4. YTM, which is the YTM per period, become 0.03, which is 3%. And coupon is 10,000 into 7.5% into 6 divided by 12 give me 375 become coupon per period. I have to find its market value. So common sense, please observe common sense. Common sense is, sir, coupon which is 375 multiplied by present value annuity factor. At the rate of 3% for 4 period, do you observe the detailings here? Then 10,000 is the face value, is the redemption value into present value factor again at the rate of 3% for fourth period. And if you do the valuation on the calci directly, what do you get? Sir, let me now teach you both the things. First, what do you have to present to the examiner? To the examiner, how do you present? You have to first solve this particular part. 1.03 divide equal. 4 times when you press equal and when you press GT, you get 3.71709 something as present value annuity factor. So to the examiner, you have to add one more step. It is 375 into 3.717. You have to take the present value factor rounded off till 3 digits after the decimal point. Then you will say plus 10,000 multiplied by 1.03 divide 1 2 3 4 4 times equal says 0.888. So for the examiner, you have to first round off the annuity factor and present value factor. And then ultimately in the next step, you show the final answer that 375 into 3.717 m plus and 10,000 into 0.888 m plus memory recollect give me 10273.88 on a rounded off basis being the final answer. The point here of learning was you have to round off the present value factor. Don't directly take the number on the calci. How much out of 10 on this particular question where you have learned the valuation if the coupon period is non-annual? Every question has a point of learning. I will just keep on revalidating at you at the end of every question. Could you learn it or not? Come on. Could you all learn it or not? Bhagya, 10 on 10. Monisha, 10 on 10. Others in the class setting here. Everyone is 10 on 10. Super brilliant people. Now, let's learn the next concept before solving the last part of the question, which means calculating the yield of a bond. Particularly YTM of a bond you are trying to people in the class calculate. The logic for which is very easy. You have an equation which is present value of future cash flow is present value, right? In the valuation part, we had the future value, we had the discounting rate, which is interest rate. So we found the present value. Now in the same equation, now if you have the present value and the future cash flow, can you not back calculate that discounting rate R or YTM? Answer is yes, and if you observe they are the same formula. I know that present value, I mean the redemption value divided by 1 plus YTM to the power n is its present value. If the present value of CMP, I know, can I not reverse calculate YTM? The answer is yes. Similarly, present value of future cash flow, coupon of the next coupon of the coming years and the redemption value all discounted by YTM gives you CMP. If you have the CMP with you, can you not somehow reverse calculate the YTM? How do you reverse calculate that? I will teach you separately. But the point is, could you connect to the core concept of time value of money, that how are the two concepts, which is concept of valuation and the concept of YTM interlinked? This one you ignore right now. But otherwise, do you connect? For example, we know that coupon into the present value annuity factor at the rate of YTM. And redemption value into present value factor at the rate of YTM give you present value. So this time if that present value is given, can you not reverse calculate somehow the YTM? Logic? Cool. Now let's learn how do we calculate it. In case of a zero coupon bond, solving this equation is really simple. I can bring the 1 plus YTM towards the LHS. I can bring the CMP here and the RHS in the denominator and solve the equation somehow to get the value. Cool. But in this case, sir, how do you do it? Frankly, in case of a coupon bearing bond, there are two ways. One is precise, which considers compounding, which is this way. Another is simple interest based, which is called as approximate method, which is also preferable in exam, which is this one. Sir, what is the logic behind this particular method? I will explain you with the help of a practical question only. But still for your common sense. I will explain that to you in the practical question only, so you will get the formula out there only. Sir, if it is a precise method, how do we solve it? Sir, is there a mathematical way to simplify it? Can you solve 1 plus YTM to the power 2, 1 plus YTM to the power 3, to the power 4 and so on? Will you be able to calculate this equation mathematically? No. So when the mathematic cannot do, the common sense comes into picture. The common sense is trial and error method. I will try to use a random number of YTM. I will try to use the 16% give me the CMP. If yes, then 16% is the correct answer. Does 17% give you CMP? If yes, then 17% is the correct answer. So you will have to do trial and error. And after you have done trial and error, you will have to use interpolation. Sir, how exactly we use it? Let me explain to you both of these methods with the help of an example that we do now. Sir, the C part of this question is actually, let me in fact not make you people do the C part of this question. Let me rather take you to a particular question where we will learn this particular thing. Question number 13. Everyone in the class, come on, please. Come on, people. 13th, where you learn the valuation, the yield calculation. Boss. Ready are we all? So let's start to read the question. There is this hypothetical company, ABC Limited, issued 10% debenture of duration 10 years. 10% debenture being issued for a duration of 10 years, which is currently trading at rupee 850 per debenture. Sir, what is the present price of the debenture? 850. The bond is convertible to 50 equity share, which are currently quoted at 17 rupee. Sir, every bond has a conversion option which can be converted to 50 equity shares. So 50 multiplied by 17 gives you 850, being the total amount after converting it to the equity shares. Fortunately, that is also the price of the bond today. All right, sir, cool. If the yield on equivalent comparable bond is 11.8%, right, in the market, everyone in the class, in the market, there are other bonds on which I will earn 11.8%. Then calculate the spread of the yield on the above bond from the comparable bond. What a question. What it is trying to ask you? The spread of a bond, meaning to say, you know what does the word spread officially means? The spread, people in the class, officially means the difference in the two yields, difference in the YTMs of two bond. Imagine that I have a bond on which my YTM is 10.8%, and there is some other bond in the market whose YTM is 9.9%. So the difference between the YTMs of two bond is how much? 10.8 minus 9.9, which is 0.9%, right, everyone? The 0.9% can also be called as 90 basis points. 1% is equal to 100 basis point. It's like subunit of percent. So 90 basis point is the yield spread, people in the class, which is being used in that practical question. So they are saying using the YTM of this particular bond, first calculate the YTM of this particular bond, use it as in compare it with the other bond of 11.8, and then find out the yield spread, which means effectively this question become the question of calculating the YTM first. Are you all aligned? Spread you can calculate only when you have YTM. Now YTM calculation for a coupon bearing bond, because life is there, coupon rate is there. For a coupon bearing bond, the YTM calculation, everyone in the class, can happen in two ways. Now I'll teach you which way is preferred. If the question is silent, you should always prefer this formula, because it is way too easy than this particular method, right? Let's do the question using both the ways. This one is way too easy, but in two particular situation you have to use precise method. Trial and error method, sir, what are two particular situations? In two situation, precise method is to be used. First, when examiner give you the data of present value factors for trial and error, sir, let me tell you, in case of approximate method that we will do now, you will observe that present value factor is of no use. But if the examiner has given you two present value factor of 11 and 13, it has an obvious implication that they want you to use the precise method. First reason of using precise. Second reason of using precise is that when you calculate YTM, if you calculate precise YTM using precise method, right? And imagine that using that YTM, you want to do any further calculation. The concept of Macaulay's duration we will learn ahead. And you will realize that in the calculation of Macaulay's duration concept, right, we need to use YTM. So if my YTM itself is not precise, if it is approximate, will the calculation of Macaulay's duration be precise, or that will also be approximate only? The second case, right? So which is why if your YTM is to be used for any further calculation, then let's make sure that first that YTM itself is precise. So in these two situations, we will use precise YTM and then we will use the approximate method. This was a particular exam tip that I wanted to give you. Boss, in this revision video, we will not only make sure that the concepts are 10 on 10 clear, we will make sure you have the applicability, you have the calculator trick, you have the presentation trick, you have the particular exam tips of applying the alternative methods. Everything I'll try to incorporate. Boss, are you all able to connect to what the discussion is going on? Please tell me. Requesting your responses, people. Requesting your responses, everyone in the class. Come on. Yes. So let me try to first solve this question using approximate method for your learning. What does approximate method tell you? The approximate method tells you that, sir, let's apply the common sense that whenever you make any investment, if you want to calculate the return on that, the common sense is that in the numerator you should take the return you have earned, and in the denominator you have take the amount that you have invested. When I invest in a bond, I earn the return in two ways. First, I earn the coupon amount every year, then I earn the capital gain. Sir, if the face value is 1000, how much is the coupon amount at the rate of 10%? 1000 face value in the coupon amount of 10% become 100 rupee of coupon every year. Plus, if I purchase the bond at 850, which in the absence of information gets redeemed at its face value, how much is the amount of capital gain? Sir, 1000 is redemption value, 850 is the purchase price. So 150 is the amount of capital gain I've made. This amount of capital gain is to be earned by an investor over a period of how many years? Sir, it is to be earned over a period of 10 years, so divided by 10. So it is the amount of coupon per annum. It is the amount of capital gain per annum. 100 plus 150 divided by 10. Yes, yes. Now, in the denominator. Now, in the denominator says that how much you invest is a different value. Today, what you invest is 850. But after 10 years, what gets redeemed is 1000. So average amount of investment is 850 plus 1000 divided by 2. So what is the logic that is going on? In the denominator comes the average amount of investment, and in the numerator comes the return that you've made on a per annum basis. And using that, if I show you the official formula, now that looks linkable. Please check it out. Sir, the approximate method formula says that first you have to take the amount of coupon. Yes, sir, taken. Then you have to take the amount of capital gain. Sir, the value at which bond which gets redeemed, 1000, minus the amount invested now, 850, divided by the time to maturity, give me the capital gain per year, capital gain per period. Logic. Divided by the amount you invest now plus the amount which gets redeemed divided by 2 gives you the average investment. Requesting your responses is the formula ultimately understood through common sense? Yes or no? Everyone in the class kindly respond. Is this formula of calculating YTM using approximate method without making any effort of present value factor and everything, is it understood now? And do you people realize for the simple formula, you don't need present value factor, anything, nothing. And if the examiner give you that present value factor, which means it is giving me a hint to use precise method, right? So let's solve it on the calci directly. Sir, let's learn how do you solve it on the calci. 1000 minus 850. 1000 minus 850 divided by 10 is the time to maturity, right? 10. Cool. Sir, plus 100 divided by, sorry, plus 100 m plus divided by 850 plus 1000 divided by 2 give me 925 as an average price, which is in the denominator is there on my calculator screen, the numerator is in there in the memory. So 925 divide equal to into memory recollect give me 12.43% as the approximate YTM. 12.43%. So now let's learn to calculate the precise YTM. Now one more exam solving tip I'm giving, please pay attention. Suppose you have to use precise method that you know, right? That examiner tells you, but it does not give you the present value factors to be used. That in that case, you don't even know what should my trials be. Should my trial be 18 and 19%, 15 and 16%, 8 or 9%? So the practical exam solving tip is in the rough, immediately calculate the approximate yield. Will not take more than a minute. Once you have the approximate yield, which is 12%, then for the purpose of trial and error, you assume one rate to be 12 and one rate to be 13. Are you understanding my point? If no, you will get it in the next 2-3 minutes. If the examiner does not give you the present value factor to be used, then first you use approximate to get the approximate yield, and for precise you create that range of 12 and 13. In this case, you are given that you have to use 11 and 13. Sir, so how do you use it? Let me teach you now. I know that the present value of future cash flow is the value of the bond. Sir, for example, future cash flow is 100 rupee of coupon to be received for the next 10 years and 1000 rupee of redemption value to be received in the 10th year. So coupon into the annuity factor and redemption value into the factor should have the present value of 850. Then in that case, how much should the YTM be? I will first try to keep YTM to be 11% and find out the present value, and then I'll try to keep YTM to be 13% and then try to find the present value. And then I will do interpolation. Sir, for that you will have to wait for a minute. Let's learn to do it first. Sir, if I assume the YTM to be 11%, right, at the rate of 11%, what is my annuity factor? Let's add up all these numbers. When I add up all these numbers, it becomes the present value annuity factor. So 100 rupee of coupon into 5.890. 100 rupee of coupon. Wait. 100 rupee of coupon multiplied by 5.890 plus 1000 rupee of redemption value into point people in the class 352 gives me the present value as 941. Okay, the value I needed was 850, but I get 941. Fine. If I use 13% as the factor, so 100 rupee into the factor, annuity factor at the rate of 13%, and then 1000 rupee of redemption value at the rate of 0.295, give me the present value as 837. So, sir, at the rate of 11% and then at the rate of 13%, I'm getting two different values at 941 and 837, but the value that I actually get is 98, that I actually want is 850. Now let us learn to do interpolation. People, if you have learned interpolation at some point in your life in this way, it is really great. However, if it is new to learn, it may take a minute for you to process. But if you learn this way of interpolation, the life really gets easy. This is so specific way of applying interpolation that it gets applied to your entire AFM, to entire CA final, to your entire life. In fact, what it says if 11% people in the class, if 11% people in the class is YTM, then the price that you get is 941. Logic, you have done it. If 13% is the annual YTM, then the price that you get is 837. So if the price that you need actually is the price that actually is 850, then how much should the YTM be? How much should the discounting rate exactly be such that I can get a price of 850? Could you connect the flow of the solution requesting your responses? Assuming two rates, discounting them, finding the value, and then trying to interpolate 11% rate give me this value, 13% rate give me this value. So if I get the value of 850, how much will the rate be? Come on. Yes, and now learning the interpolation. First was the creation of the situation where you can feel that yes, there is a need of interpolation. Now the equation of interpolation being really easy. I will say there is a rhythm if you understand. I will say this minus this divided by this minus this means x minus 11 divided by 13 minus 11. X minus 11 divided by 13 minus 11. The rhythm that you're applying in LHS, the same rhythm you apply on RHS, that 850 minus 941 divided by 837 minus 941. So 850 minus 931 divided by 941 divided by 837 minus 941. If you have learned any other way of interpolation in a comfortable, you can do it. But let me tell you, this one is more specific, making less possibility of mathematical error. And second, whatever you have learned, I am trying to teach you the derivation of your learning. This is where your formula was derived from. And now in this entire equation, if only one number x is missing, can you find it? Yes, sir. First, you solve this on the calculator, put it to m plus. Then you solve this in the on the calculator, press divide equal to into memory recollect, automatically will solve this entire RHS. For example, 850 minus 941 m plus, 91 negative number in my memory. Then 837.6 minus 941 is equal to negative 1.103.4 on my calc in the denominator. Denominator on my calculator screen, numerator on my memory. So I will now press 103.4 is on my calci screen. I will press divide equal to into memory recollect is equal to 0.8800. 0.8800. This entire thing gets solved. Right now, what do? Now you multiply it with 2, multiply it with 2, plus you press 11, give me 12.76% people as the 12.76% as the YTM that you specifically need to get the required to get the price of 850, which means my precise YTM is 12.76. How much out of 10 on this particular question and this particular concept till this point requesting your responses? Every live and recorded people in the class sitting in the air, sitting here, kindly respond. Please everyone, please everyone. Was perfect, clear, sorted. So now, was the question just to calculate the YTM or it was to calculate spread comparing it with another bond? Sir, on my bond, this YTM is 12.76, but on in that another bond, if it is 11.8, difference of 0.96% is the spread that the examiner wanted us to calculate. So with this question, let me summarize what have you learned. First, you have learned how do you calculate. First, you have learned to figure out if the given bond, which is a coupon bearing bond, for that given bond, which method to apply approximate or precise. You have learned it, right? In the two case, you apply precise, otherwise it is all approximate. If the for precise, the present value factors are given good enough. If no, then you have to first in the rough work do the approximate calculation so that you get the two numbers to try, right? Then if you have those two numbers to try, then you follow this particular approach, try using those numbers, do interpolate, and you have also learned the way to do the interpolation in this question. So that was people in the class question number 13, where you have learned this and this. Brilliant, sir. Now, one more point of learning related to which I will show you which practical question number is that. Do you remember in case of valuation, we did a question where I taught you that coupons are not coupons per annum, they are coupons per period. YTM people in the class is YTM per period and N is number of period. The same logic gets applies to the calculation of YTM. Sir, in case of while calculating YTM, can we have a semi-annual bond given in the question? Yes. So in that case also, you are reverse calculating YTM. Agreed, sir. Fine, sir. So what are the coupons you will take? Will it be coupon per annum? No, coupon per period. Will your N be number of years or number of period? Number of period. The CMP, if is already given, the YTM that you reverse calculate will not be YTM per annum. It will automatically reverse calculated YTM per period. It is the, if using trial and error method or any formula, this formula is this formula. If you calculate the YTM, that is YTM per period and not per annum. Sir, that is what will exactly happen in question number 8, part number C, which is the part I have added for this class students, not by the institute. This one is right. If you solve it, you will realize how can you first calculate the periodic YTM, which is YTM per 6 month, and then multiply it with 2. So if 6 month YTM, this how much is the per annum YTM multiplied by 2, then calculating an annual YTM. Because if a coupon period is 6 months, the YTM so calculated is first a 6 monthly YTM automatically, then you have to convert it to the annual. That was this particular question, people, and this particular concept. Now let me figure out what the next question should be. The next question, everyone in the class, is question number 16. We don't have to do this question in the class, but I have to teach you the point of learning of this question, right? Starting with the first one, making you people understand the concept of current yield. The concept of people in the class, current yield. YTM was a type of yield calculation which consider all the inflows and outflows related to the cash flow, right? It includes present initial outflow of CMP. It includes the coupons inflow, if any. It includes the redemption value which you receive on maturity. So YTM is a type of yield which consider all the type of inflows and outflows associated to that bond. Cool. Then is the current yield, which is a type of yield which does not consider the inflows and outflows of redemption day, of maturity day. It considers only the current income, the current cash flow, which is the coupon cash flow. Sir, when you invest in a bond today, you earn coupon. Second, you earn the capital gain. Capital gain is through the redemption value. Redemption value you get on maturity after 10 years, for example, but the coupon is a current income you receive every year. So current yield considers current income. It says in the denominator comes what you invest, in the numerator comes what you earn. So today what I invest to buy the bond is at CMP, and on that the annual coupon that I receive is my current income. Ignore the redemption value or the capital gain, and that is what people in the class, what current yield is. That simple formula. So sir, for a current yield calculation, question number 16 you can refer to. I'll read the question, we will not do it, just explain what this question says. Question says that there is a bond, right, for which the discounting rate you apply depends on the risk you take. Do you agree to this? Yes. Risk is told by credit rating. A bond which has AAA credit rating has the least risk, right? The bond which is between the three has less risk. AAA credit rating bond has less risk. Single A credit rated bond is a lesser credit rating, has a higher risk. So if the credit rating is AAA, required rate of return on the bond, the discounting rate is the 364-day treasury bill rate, which means the risk-free rate, plus 3% extra. If it is AA rated bond, then whatever you need for AAA plus 2%. And if it is a single A rated bond, then whatever is the required rate of return for AAA plus 3% spread is what you need. Suppose I'm considering a bond which is AA rated. So my discounting rate will be this plus 3% plus 2%. Agreed, sir. Current face value 1000 rupee, current market price 1025. Bond has 5 year of time to maturity, coupon rate 15% paid annually, right? The interest is due 1 year from today. Obviously, the first interest to be paid after a year, right? Bond is redeemable at par, which means face value is the redemption value. Treasury bill rate, risk free rate is 9%. So my discounting rate is 9 plus 3 plus 2 is equal to 14%, first of all. Discounting rate is 9 plus 3 plus 2 is 14%. Second, you have to calculate the intrinsic value. So face value of 1000 into the coupon rate of 15%. So 150 rupee of coupon to be received for the next 5 year discounted at the rate of 14%, and 1000 rupee of redemption value to be received in fifth year discounted at the rate of 14%. Simple present value of future cash flow, you get the intrinsic value. Cool. Should he invest in the bond? So I will say CMP is 1025. Since the price of 1025 is less than its intrinsic value of 1034, then the bond is undervalued and we should make the investment. That answer you have to manually write, it's missing. Since the intrinsic value of the bond is less than, one second. Sorry, people, just give me a second. But I'm not writing it down. I'm not wasting my time right now in this revision video. Kindly update this. That since the CMP of the bond, since the CMP of the bond 1025 is less than the intrinsic value of 1034, therefore the bond is undervalued and we should invest in the bond. The conclusion is clear. Sir, third, calculate the current yield. Sir, current yield considers only current income, right? So how much is the current income? 150 rupee of coupon. And to earn that coupon, how much is the investment or the price you have to pay in the denominator is 1025.86, right? This divided by this gives you, everyone in the class, the current yield of 14.62, and ultimately asking what is a YTM. For YTM, there is precise method and approximate method. Is the present value factor given? No. So no need to apply precise. Is this YTM to be further used anywhere? No. So we can use, people in the class, approximate method, which is the YTM calculation of amount of coupon earned, then the amount of capital gain per annum divided by the average amount of investment give you 14.30%, which I have not calculated in the class because it's done previously in one particular question. Question number 16. Could I explain the points of learning? Boss, we are smart students. We don't have to do the same thing again and again. If a question has the point of learning, we will focus on those particular things. The point of learning here was able to calculate the discounting rate based on the credit rating, which is risk involved. Second point of learning was calculating the current yield. And third point of learning was applying the under overvaluation part. Question 16 is clear. Sir, next thing that you need to learn in the class is again very brilliant conceptually, 10 of 10 clear learning, people, the valuation of a bond on other than coupon dates. If I ask you, imagine there is a bond of 4 years. Agreed, sir. Having a coupon face value of 1000, coupon rate of 8%. So if you imagine the cash flow 80 rupee coupon and the redemption value finally is 1000. Sir, if I ask you to value the bond here, you will discount all these future cash flow at the rate of 10% and find the value here very easy. If I ask you to value the bond here, you will discount the next two future cash flow of 80 and 1000, bring them to present value here. However, if I ask you to value the bond at 1.5 year end, which means between the two coupon dates, then the calculation becomes slightly different. That is what you're trying to learn here. Before we start to learn, are you people conceptually clear what are we going to learn in this question? And then we also solve a practical question for it so that you realize that yes, sir, we are literally applying the concepts really well, not just learning them. Yes. So boss, get ready for that easy timeline driven concept. Your imagination is going to make you all easy, make this concept easy. Sir, I want to do the value at 1.5 year. So time to maturity left now, people, is 2.5. So why don't you simply do the valuation, sir, which is 80 into the present value annuity factor, 80 into the annuity factor plus a redemption value of 1000 into the present value factor. Why don't you apply simple valuation? Because this scenario does not gets approved by annuity. Annuity says same time period of gap and same time amount. Sir, the gap here is 6 months, but the gap here then is 1 year and 1 year. So if the gap is 1 year, 6 months, people, do you realize it is not annuity? You cannot apply annuity factor, which is what the start of the problem is. First, you understand the problem, then you are able to differentiate how this particular concept is different from the previous one, and then I will teach you the solution, which is really logical. What is logical solution? Sir, logical solution is At here, at this point, it is not an annuity. But at this point, is it an annuity? Is my first future cash flow after a year, then second future cash flow after one further year, and is the amount of future cash flow same? Yes, which means you can apply annuity logic here. So let's first value the bond here, discount the future cash flows. What is the value of the bond at the end of second year is really simple. Sir, 80 rupee into present value annuity factor for 2 years and 1000 rupee into present value factor of 2 years. Discounted at the rate of YTM of 10%, which gives me 965.29 as the value. Is it okay, everyone in the class, if I don't show the calculation and you trust me that, sir, logical, this is going to be the present value of future cash flow? Come on, requesting your responses. Can you, since we have done the valuation multiple times, can you all trust me on that now? Agreed. So now we realize that, sir, okay, this is the present value of future cash flow. In this future cash flow, in this present value, what all has been discounted? The coupon of third and fourth year have been discounted and the redemption value of fourth is discounted. Where I ultimately need to value the bond is here. When I stand here, what are my future cash flow? This 80 is my future cash flow and these are my future cash flow. All these have been discounted to 965, but 80 is yet to be discounted, right? So at the end of second year, I have this value already there with me and 80 is also the coupon amount that I'll receive at the end of second. So the total future cash flow, like the total cash flow at the end of second year is 1045.29, which is 965 plus 80 is 1045.29. So at the end of 1.5 year, when I stand, I will say the future cash flow is 1045.29, which is this 80 and this 965. And the ultimate logic still remain the same. The value of a bond is the present value of future cash flow. Just that we have to do the present valuation or the discounting in parts. First, we discounted this particular amount to bring it to second year. Now we discount the cash flow of second year along with this value for a further period of 6 months. So I will say 1045 is to be discounted by 6 months, which is simply 1045 divided by 1 plus the discounting rate for how many months? For 6 months. If 10% is the discounting rate for the entire year, then for 5% it is 10 into 6 by 12. For 10, if 1 second, if 10% is the discounting rate for the entire year, then for 6 months the rate is 10 into 6 by 12, which is people in the class 5%. So 1045.29, everyone in the class divided by 1.05 gives me the finally value, the present value of all the future cash flow, which is second, third, fourth, everything at the end of 1.5 year. Till this point, everyone in the class, are you all very well settled, satisfied? What do you say? Are you all very well settled and satisfied? What do you say? Come on. Yes or no? The price that you have calculated is the value of the bond at the end of 1.5 year, which was my first point of learning. What is this price officially called as? It is officially called as full price. It is also called as dirty price. It is also called as invoice price actually. What is it called as? Full price, also called as dirty price, also called as invoice price. Meaning to say, if I sell you this bond at the end of 1.5 year, then you have to pay me an amount equal to its full price, which is 995.51. Not just teaching you the calculation, but the usage of that calculation, that what is 995. When I sell you bond, you pay me 995.51. Agreed. Sir, today when I sell this bond to you, then at the end of second year, company will pay you coupon. Yes. How much coupon will the company pay you? Company will pay you the entire coupon of people 1 year, which is 80 rupee is what the company will pay you. So company, when I sell this bond to you, you hold it for the next 6 months, but you receive the coupon for the entire year. Is it logical? Yes. Because at the end of this 6 month here, when I sold that bond to you, in that bond value, you have already paid to me the value equal to 6 months of coupon. You have paid to me an amount equal to 6 months of coupon because I deserve to receive it. The coupon of the first 6 months I deserve to receive. So in this value of 995 that you have paid to me, it is included In that value is included the amount of coupon for the first 6 months. So at this point, you have paid to me the coupon for the first 6 months. And at the end of second year, you receive from the company, the issuer, the coupon for the entire year. So automatically, net you receive is what you deserve, which is the coupon for the next 6 months. Could you understand my point? People in the class, please respond. Could you understand my point? People in the class, please respond. Yes or no? Yes. So if I from this eliminate in this total price that you pay me, if I try to eliminate how much of the value you are paying to me in the form of coupon of the first 6 months, so I will deduct the amount of accrued coupon from it. Sir, if the entire year coupon, people in the class, for the entire year of 12 months, if the coupon amount is 80, then for the first 6 months for which I deserve to receive the coupon, how much is that amount? So 80 into 6 divided by 12 give me 40. Through the timeline, it become conceptually very much clear that when you deduct the coupon amount, it is for this period. When you discount it further, it is for this period. This conceptual clarity of the timeline, people, takes you to the exam hall, make you people solve the question without mistake and securing marks, scoring great marks in fact. Yes. So I will say the accrued interest, the accrued coupon is 40 rupee. So in this total amount of 995 that you've paid to me, 40 rupees the amount of coupon that you've paid, which I deserve. So you gave that amount to me as it is. So how much is the amount you've paid for the value of the bond, excluding the accrued coupon? It is the flat price that you pay me, which is 955.51. Deducting this from this give me the flat price. So this price is called as flat price. This price is also called as clean price. That is what the value excluding the coupon amount, accrued coupon of the first 6 months. This was the concept, right? On which we will do a practical question now to make this concept further clear, the applicability clear, and then you will say, sir, we are 10 on 10. I know you are settled right now, but let's solve a question to bring that confidence from within that, yes, sir, that's how we should logically solve the question and you are aligned to it. Let's do it. Sir, last point of learning. Can I say full price minus accrued interest is equal to flat price? So very similarly, can I say flat price plus accrued interest is going to be my full price? Yes, sir, obviously. Which means, you know what? A bond, when gets traded in the market, the bond has a market price which is quoted at which it is quoted, right? The bond is always quoted in the market. The bond gets traded in the market at its flat price, not the full price. So if I go to the market, see the price of the bond, what price of it will it be? It will be its flat price. So when I purchase the bond at this price, the amount that I have to pay to you is not just this price. I have to add accrued interest to it, and in total, I'll have to pay you 995.51. Are you all please realizing my point, everyone in the class? In the market, the price which is there is flat, to which I'll have to add the accrued interest to get the full price, and that is the amount I'll have to pay when I purchase the bond from anyone in the market. Sir, that was the concept, everyone. Now let's solve a practical question of this type. So the question that you solve is question number 19. Let us proceed. Let me open my regular batch notes. So we have this full English regular batch, right? Where, let me check if I did explain this concept on the timeline or not. In the regular batch, what we do, we learn most of our concepts through timeline, bringing the clarity beyond, imagination. Cool. And through that, the students are able to really solve the questions. So similarly, for the chapter of fixed income security, let me check if this timeline was there or not. Wait. Wow, it's there. So thank you so much. It's there, everyone. Let's learn the question through timeline. Question number 90 says, MP Limited issued a bond on 1st Jan 10. All right, sir, on this date we issued the bond. The bond were sold at par. The bond were issued at par. Cool. Sir, having a coupon rate of 10% per annum, maturing on 31st December 25. So maturity will be 31st December 25. How much is the original maturity? How much is the original maturity? From 2010 to 2025, is it 15 years? The answer is no. From 1st Jan 10 to 31st December 25, it is people in the class 16 years. So don't make this mistake, which requires your presence of mind, which requires attention to details. Cool. So, sir, this one I know is 16 years. Sir, coupon payments are made semi-annually on June 30 and December 31. Sir, what a question. We have to do semi-annual payments. Yes, sir. Cool. Assuming that you purchase a outstanding bond on 1st March 18. The bond was issued on 1st Jan 10. But suppose I decide to purchase it on 1st March 18. Where do I stand 1st March 18? Sir, where the going on interest rate is 12%. Because on that day, when I stand, the YTM in the market is 12%. Coupon does not change. Coupon continue to remain same throughout the life of the bond, private, right? Generally, which is a fixed coupon bond, right? However, if the YTM, the bond is discounted using a YTM which keeps on changing in the market. So on the date of issue, what was the YTM? We are not being told. But on the date when I'm standing and purchasing the bond, the YTM people in the market is 12%. So if I have to value the bond, I have to discount it using the YTM that prevails on that day, which is discounted at the rate of 12%. Fine. What is the YTM of the bond on Jan 1, 2010 on the date of issue? What is the YTM? Sir, for YTM, I need CMP. The bond were sold at par. What does this line mean? It means that the issue price is equal to the face value of 1000 rupee. So, sir, if I have the issue price, if I have the future cash flow, can we find out the interest? Obviously, sir. Sir, let's look at this. I have to calculate the periodic YTM. Sir, why periodic YTM? Because everyone in the class, hello, Kamal, what are you doing? Share your English class notes. So why would you spam it? Why would you spam it? Handwritten notes, I cannot share. The concepts notes that you see here, I have already shared. The handwritten notes, actually, we don't share it to anyone. But have you been watching me for very long, or here just for a moment? So anyways, people, Kamal, are you planning to be there throughout the session? What's the plan? Please tell me. Oh, so I didn't get a response from you, so I didn't know you are here. So, anyways, are you understanding everything? Are you aligned to whatever is going on? I'm really sorry for my inability to share the handwritten notes. That's actually not available for sharing. Yes. So, anyways, sir, if we have to calculate YTM, since the coupons are periodic, which means, do you realize even the YTM is periodic? So let's do. I will say how much is the amount of coupon I'll receive every 6 months. So 10% per annum is the coupon rate, right? Face value is 1000. So 1000 into 10% is 100. But for a period of 6 months, it becomes 50. Fine, sir. Issue price 100, redemption value 100, issued at par, redeemed at par. So capital gain is 0. Over a period of 16 years, no. Over a period of 32 periods, how much is over the time of 32 periods? Sir, how much is the capital gain per period? 0. Could you apply? I am thinking periodically, I'm not thinking annually. Divided by average investment today, 1000, that day 1000. So average become 1000. So this becomes 0 and 50 divided by 1000 become 5% per 6 months. For a period of 6 months, the YTM that I've calculated using approximate method is 5%. So for a period of per annum, the YTM required YTM will be 5 into 2, which is 10% per annum. Guys, how much out of 10 on this particular part? Kindly respond. How much out of 10 on this particular part? 10%. Sir, one point of concept I am telling you right now. I will not be able to explain the logic behind it because of shortage of time, but one point I am trying to explain, right? You ignore this first of all. You ignore this. This is our regular batch notes which has explanation of everything. But what I want to mainly explain to you in the class right now, which you'll have to remember, is that if the coupon amount is equal to YTM, if the coupon amount is equal to YTM, then the current market price or the issue price of the bond will be equal to face value. I'll repeat. Otherwise, I'll repeat other way around. If the current market price is equal to face value, do you people agree in this question the issue price, which is its current market price of 1000, was equal to the face value of 1000? If 1000 is the current market price and 1000 is the face value, if this is equal to this, then it automatically implies that the coupon and the YTM of the two of that particular bond, the two things will be equal. So which is why, do you observe when I solve this question, everyone, do you observe that issue price, the current market price, was equal to face value, which is why the YTM that you have calculated turned out to be equal to the coupon rate of 10%, which is given in the question. Could you connect it to this particular thing that I'm trying to explain? Requesting your responses, everyone. This is again a particular exam tip. Why? Imagine examiner gives you a question, asks you something, and it does not give you YTM. Then in that case, you should be able to connect that, okay, issue price is equal to face value, then the YTM is equal to coupon rate, that I can directly use to solve a practical question. Yes, that was first part. Sir, why have you applied approximate method and not precise? Because there was no need of precise. We don't have present value factor. We don't have to use this YTM further. In the B part of the question, let's do the valuation. How much is the amount you would pay to complete the transaction? Sir, which transaction are you talking about? The transaction to purchase an outstanding bond. How much is the amount you will pay, and of that amount how much is accrued interest and how much is the bond basic value, which means first you have to find the dirty price. You are purchasing the bond on 1st March between the two coupon dates. On that day, when you value the bond, you get dirty price, from which if you deduct the accrued interest, you get the clean price. So let's imagine the timeline. On 1st of 18, I have to purchase a bond. What is the very next coupon date? I will have to first value the bond on that particular date. My very next coupon date will be on 30th of June 2018, because in December and in June, 30th June and 31st December, the payments are made. So after March, I get June. On this day when I stand, let's figure out how many periods are left. From 30th June 18 to 31st December 18 is one period, right? Is one period. Now from 31st December 18, 19, 20, 21, 22, 23, 24, 25. Overall, 31st December 25, which is my maturity date, I have total of 7. 1 second. After 31st December 18, 31st June. So my bad. I'll say that again. I'm standing on 30th June. My bad, I'll repeat that again. Please pay attention again. On 1st March 18 is where I stand. My next coupon date is 30th June 18. Aligned, sir. From 30th June 18, I'm trying to figure out how many periods are left. So one period is 30th December, 31st December 18. Agreed, sir. After 31st December 18, 19, 20, 21, 22, 23, 24, 25. 7 years will give me 7 into 2, 14 period plus 1 period plus this particular period from 30th June 18 to 31st December 18 gives me total of 15 period till maturity. So on this day when I do the valuation, I will need the present value considering 15 periods, where YTM right now is at this point it is 12% per annum. Please observe, is not 10%. 10% it was then, now it is 12% per annum. So for 6 months it becomes 6%. So rate per period, 15 is the number of period when you do value the bond. Coupon per period is 50. When you do the valuation, sir, apply present value annuity factor. Present value factor, the value is 902.6. At which point the value is 902 point? At this point. Has the coupon of 50 included in this? No, sir. Only the future cash flows have been included. So 902.5 plus 50 gives me 952.6. The total value here including this coupon. Now you have to discount it for a further period of how many months? March, April, May, June. For a period of 4 months, you have to further discount it. Rate for 6 months is how much? 6%. For 4 months, it become how much proportionately? Sir, For 6 months, it is 6%. So 4 months, it become 4 by 6. So this 50, this value of 952 is further discounted back for a period of 4 months from 30th June to 1st of March by dividing it 1 plus by dividing it by 1 plus 0.06 into 4 by 6 give me 915.96 is the total value that you have to pay on 1st of March to purchase the bond to complete this transaction, which is its dirty price of 915.96. Till this point, how much out of 10 could you feel the application of the concept learned in the out notes in the question which is there in the out scanner? Come on. We not only focus on clarity of concept, that's the old trend we had set. Now we are taking it a step ahead, learning those clarity to the practical questions. People, requesting your responses. Everyone. What do you say? Yes, perfect. Guys, why would Kamal, are you still there? Why have you deleted the messages? Just randomly. Are you still there, Kamal, with us, learning whatever is going on? Yes or no? Yes, settled, learning, great. So, everyone else, if I have the value on this date, then from my last coupon date, from my previous coupon date, it was, sir, I'm standing on 1st of March 18, my previous coupon date on 31/12/17. For this period, if I deduct the amount of coupon, so 50 is the coupon for 6 months, right? 50 is the coupon for 6 months, right? Or I can say 100 is the coupon for the entire year. Then for 2 months, which means Jan and Feb, how much is the coupon? Sir, 50 is the coupon for the entire period of 6 months. For Jan Feb, it become 2 by 6, which is 16.67. So remaining is the flat price, which is bond's basic value, which is 899.29. Requesting your responses. Question number 19, where I wanted to teach you this particular concept's applicability, the applicability of this particular concept. Are we settled? Come on, requesting your responses. Please. Settled, are we? Done? Yes, taking you all ahead. Now, first of all, I'll tell you what is this particular concept that we have not learnt in the class so far and we have not done a practical question. It is a concept of people in the class realized yield. Three types of yield you have in the curriculum. YTM, which has most of the questions. Then you have current yield, on which you have 1 to 2 questions. Then you have realized yield, on which you have 1 to 2 questions again. We have learnt YTM, we have learnt your current yield. Now realized yield, I'll just teach you, but we will not solve a practical question on this. You will have to, people in the class, do it yourself. Yes. Can I proceed ahead? Do I have the permission? Are you people clear with the last thing that you've done in the class? Come on, tell me, please. The concept of realized yield you have to learn. Imagine that there is a bond in the market whose price is 951.96. All right, sir. The future cash flows that you will receive from the bond. So imagine that face value is 1000, coupon rate is 10%. So how much you will receive is the coupon of 100 rupee every year for the next 3 years. The present value of the bond, suppose, is given to me at 951.96. So do I have the future cash inflows? Yes. You have the initial outflow? Yes. If I ask you to calculate the return, you give me YTM, which considers the cash inflow to be received at the end of first and second and third year to me. But when I make an investment in the YTM in the practical world, when I invest in the bond in the practical world, I don't want to receive these cash flows at the end of first and second year, because I ultimately want to receive all my cash flows at the end of third year, which is my investment horizon. If I want to invest for 3 years, I should receive everything at the end of third year. Logical, sir. Cool. Now what do I do? Sir, if the company pays me coupon at the end of first and second year, I don't receive it. I rather decide to reinvest it for a period of rest of the time. This coupon of first year of 100 rupee, I will reinvest for a period of next 2 years. This coupon of second year of 100 rupee, I decide to reinvest it for a period of 1 year with the mindset that I would receive all these cash flows at the end of third year only. Which means, has the inflow come to me at the end of first and second year? The answer is no. It got reinvested. Point of learning here is the reinvestment will happen at a rate which prevails in the market. YTM keeps on changing. At the end of first year, if the YTM is 14, that 100 rupee after 2 year become 100 plus 14%, 100 plus 14% plus 14% give me 229.96. With the return of 2 years, with compounding effect, the rupee 100 will become 129.96. Cool. This 100 at the end of second year, when I went to the market to invest, I realized that YTM has fallen to 8% and it will only become 108 as the YTM keeps on changing, right? For this, the return was 14, you got a value. For this, the return was 8, you got a value. Fine, sir. And at the end of third year, you will anyways receive 100 and 1100, for which you don't have any need to reinvest. So now do you agree at the end of third year, I have the coupon and redemption value of 1100 plus the coupons of the first 2 year which got redeemed as 108 and 120.96, giving me an overall inflow of 1337.96. Till this point, people in the class, on the imagination of cash flows, are you clear? My first request to you is the imagination of cash flow here, the return calculation, which is the realized yield, is all easy. I will teach you now. Come on. Which means from my pocket, if you imagine the cash flows, do you agree there is just one outflow of 951.96 and there is just one particular inflow of 1337.96? Yes or no? If I have the initial outflow at 0 point, if I have the ultimate inflow at the end of third year, can you please reverse calculate the rate of return being earned on it? The answer is yes. And how do you calculate it? Simple logic, present value into 1 plus r to the power n is equal to future value. Is this the formula to calculate the rate of, is this the formula to calculate present value to future value using compounding? Correct. If you this time have the present value and future value, can I you reverse calculate the R, which will be the compounded annual rate of return, which will the compounded annual rate at which the compounding happens? Correct, sir? Yes. So if 951.96 is the present value, 1337.96 is the future value, then 1 plus R to the power 3. In this entire equation, only one particular number is missing, R. Can you calculate it? Yes. How do you calculate it is something I will not teach you now, right? Just guide you on that. Just guide you. Sir, this number you take it in the R LHS in the RHS in the denominator. Yes, sir. So it become 1 plus R to the power 3 become 1.045. Now, sir, 1 plus R become 1.0445 to the power 1 by 3. The power here comes here in the denominator. Yes. How do you solve it, sir? You have to solve it using dirty power. I'm not explaining in this class right now how do you do dirty power, but the point is using the dirty power calculation, right, which is there in the basics of AFM page in the OutScanner, right, OutNotes, the concept notes basic of AFM has the steps to calculate dirty power. Using that, you can calculate R. Focus is not how do you do dirty power. Assume that you know dirty power calculation. Assume that in the R calculated using that is 12.02. You have to understand the sense of the concept. That when you reinvest this 100 and 100 at 14 and 8%, the amount you will receive on maturity will be this. And using that mindset, how much is the actual return which you could ultimately realize? How much is the actual return which you could ultimately generate, ultimately realized on the day of maturity is realized yield, which is 12.02%, which involves assumption of reinvesting of the coupon at the respective reinvestment rate, respective YTM which prevails on respective date, and then finally calculating return. Could I succeed in explaining people in the class this particular thing? Please tell me. Could I, everyone in the class, succeed in that? What do you say, people? Come on, come on, come on. Requesting your responses. Yes. So that is how you calculate realized yield, for which we will not. I am completely transparent. Everything that I do, I claim it that see, we have done the application. Everything that I not do, I am happy, transparent to share it. The question you'll have to look at it at your own. The question of realized yield. Sir, now Since it's been 2 hours, I don't think we should take a break right now. Let's first complete 1 hour of next topic, which is very logical. Won't take 1 hour, I think. After doing that topic, we proceed to take a break. Are you people comfortable with it? Come on. Let's have the learning for the next 1 hour or 45 minutes or whatever, which will have the next topic entirely done. Comfortable? Yes, because the purpose is to make this lecture efficient, to be able to do as much as possible out of it. Yes, everyone. So I will say, if this is done, the next thing you are learning is the top-notch conceptual clarity and the top-notch level of comfort of applying those concepts to the practical question, making your life easy, learning the spot and forward interest rate with its best. Yes. Sir, you have right now learned the YTM to be a rate of interest, right? The rate of return. Using the rate of YTM, yes, sir, you can discount the future cash flow, which means if your future cash flows, you can discount. If these are your future cash flows, you can discount them using YTM. Aligned, sir. Cool. Now let's first of all learn what is spot and forward rate of interest. Some people understand what are they, some people don't. Almost no one understands, almost no one understand, sir, how is a spot and forward interest rate different from YTM, which we have already learned, except for the class students I'm saying, right? So this clarity is giving you the difference, that when you look at the practical question, how do you identify this is not a YTM question and this is spot forward question, and why car, how are the two different, that you learn. Then you will learn the valuation using spot rate. Then you will learn the valuation using forward rate. This is what the entire concept will be, starting with the learning of spot and forward. Sir, spot and forwards are the rates of interest that prevail in the market. Sir, why are rates of interest prevailing in the market? They are prevailing so that if someone wants to borrow, they can borrow at that rate. So that if someone wants to lend, you can lend at that rate. For example, you go to the bank asking the bank that, bank, I want to borrow today. What is the rate of interest available? So bank says, what is the period for which you want to borrow? We say, how does it matter? The bank says, every period has a different rate. Meaning to say, you want to borrow today for a period of 1 year, rate is 5% per annum. But if you want to borrow today for a period of 2 years, then rate is 5.5% per annum. For 3 years, it is 6% per annum. For 4 years, it is 6.5% per annum. So for different period of borrowing that starts today, right, the rate is different. We call these rates to be the spot rates. Requesting your response is the first thing, clear? At every step, I'll need your validation so that I get a confidence that I could deliver it to you 10 out of 10. Come on. Live people sitting here, recorded people, please tell me. Yes. Just give me a second. Just give. Yes, people. There. Sir, next. If you want to borrow today, the spot rate prevails in the market, right? However, if you want to borrow after a year, what will be the spot rate prevailing on that day? Which means after a year, for a period of 1 year, if I go to the bank, suppose I go to the bank after a year, saying that, bank, what is the rate prevailing today on this particular date for the next 1 year? That rate that will prevail in the market, that spot rate that will prevail in the market, we cannot guess it today. If I stand, I do not know it. This rate will depend on the economic situation of that day. On that day, if there is a war among countries, if there is an inflation, all those reasons, people in the class, all those reasons, people in the class will decide the rate of interest that will prevail, the spot rate that will prevail on that day. Today we cannot guess it. Today we can know only the spot rate of today. Cool, sir. Then, if I want to borrow for a future date, the rate, the spot rate, we do not know. But can we, people in the class, somehow have a rate fixed today for that period? Today I go to the bank. I say the bank, that bank, after a year, for a year, the rate in the spot market which will prevail, we don't know. But can we fix a rate today? The bank says yes. So today you can fix a rate for borrowing or lending with the bank, right? Which rate is called as forward rate. So rate of borrowing applicable on a future rate, future period, right? In the spot rate, the borrowing was starting today. So rate applicable to a borrowing that starts on a future date, which means borrowing after a year, for 1 year, for 2 year, or for 3 years, or borrowing after 2 year for 1 or 3 years. That is people in the class. That is everyone in the class. Everyone in the class, forward rate. So how spot rate are different for different periods, the forward rates are also different for different period. After 1 year, for 1 year, rate will be different for annum. After 2 year, for 2 year, rate will be different per annum. Boss, first point, rate applicable to a borrowing that start today is a spot rate. Rate applicable for a borrowing that starts on a future date is a forward rate. Requesting your responses, are these two things clear to every single student sitting in the class? Now I'll explain the most important line that decides. Now I'll say a most important line that decides how strongly, how comfortably you'll be able to solve the practical question. Should I say that? Sir, before that, let me explain how is spot and forward, which is a particular concept. Spot and forward, which are these concepts, different from YTM. Different from YTM. Let me explain it. Sir, if I have to value a bond using YTM, suppose I have to value a bond here, YTM in the market is 10%. Do you agree I will discount all these cash flows at the rate of 10%? Yes. But the point with the spot forward is that in case of spot forward, every period has a different rate. You cannot discount the cash flow of different periods using a same rate. Meaning to say, for this 1 year period from 0 to 1, what is the rate? 5%. Meaning to say, if you have to calculate the future value of any cash flow from 0 to 1, rate is 5%. If you have to calculate the cash flow present value from 1 to 0, the rate is 5%. Similarly, from 0 to 2, 2 to 0, if you have to do, the rate is 5.5. From 0 to 3, 3 to 0, the rate is 6. Sir, using this rate of 6%, can I calculate 1 to 0 and 0 to 1? Because 1 year is a part of 3 year, the answer is no. These rates, speaking the most important line, these rates can be used to compound or discount the cash flow only for that particular time period to which the rate belongs. Since this 4 year rate belong to 4 years, it can only be used, only and only be used to compound the cash flow from 0 to 4 or to discount the cash flow from 4 to 0. Could you understand what I just explained? The same goes to the forward rate. Sir, if the forward rate is for a period of 1 year to 3 year, officially calling it to be forward rate 1 by 3. If there's a rate of borrowing after a period for a period of 2 years, after a year for a period of 2 years, which means from year 1 to 3, we call it forward rate 1 by 3. And this particular forward rate can be used only and only to discount the cash flow from 1 to 3, 3 to 1. That's all. It cannot be used for 1 to 2 or 2 to 3 or 3 to 2 or 2 to 1, or assuming that it is a rate of 2 years, then let's discount it from 2 to 0. No, no, no. Only possibility is 1 to 3 and 3 to 1. Could I explain the clarity of concept which will make your practical question solving easy and mark secure? Easy. Yes. So now is the point of difference between YTM. Sir, when I have to value a bond using YTM, all the cash flow, whether it is a cash flow of 1 year, 2 year, 3 year, 4 year, any cash flow using or discounted using the same rate of YTM. But now when I have to value a bond using spot rate or forward rate, different maturity of cash flow has different rate, which can be, and only they can be used for the purpose of valuation. Do you now realize what are these particular rates, and why is this particular topic a different topic than YTM? How much out of 10 people on this being delivered? Requesting your responses. And I would again remind everyone, if you people feel live ones and recorded ones that the video has really helped you out, then you have to support me by putting comment what your genuine uh, experience was throughout this lecture, by sharing these with your friends and juniors, and I'm sure this video is going to help them as well. Clear? So now I'll take you to some more things, some more terminologies before I go to the next concept on which the practical question is to be done. Sir, terminologies first. Spot rate start today, future rate starting on a future date, right? All that is fixed today. Forward rate starting on a future lending borrowing is fixed today only. Sir, spot rates are also called as zero bond rate, zero rates, zero coupon bond rates and zero rates. Sir, why are they called as? Let me not explain, although the reason is here. Sir, they are calculated as the YTM of a zero coupon bond. I'll speak a line, I will not explain it, I'll just speak it. Do you agree the common feature between a zero coupon bond and a spot rate is that zero coupon bond exists today? If there is a zero coupon bond that is issued today, for example, then the spot rate is also something that exists today. Second common feature, zero coupon bond has no intermediate cash flow. If the zero coupon bond is of 3 year, it has the cash flow today when I issue the bond, and it has the cash flow at the end when the bond is redeemed. No intermediate cash flow. If the bond is for 4 year, then the cash flow is only at 0 and 4, no intermediate cash flow. And that is also the feature of the spot rate. That spot rate has the cash flow today, and then it has the cash flow only at the end, no cash flow in between. And which is why zero coupon bond and the spot rate has similarity, and which is why, how do you calculate a spot rate? It is nothing but a YTM of a zero coupon bond. Have you people in the class ever learned the YTM of a zero coupon bond? Answer is yes, like this. This is how you calculate the YTM of a zero coupon bond, and that become your spot rate. People, this concept will help you to make the question, interpret the question in a better way. So yes, sir, this is clear. Forward rate is clear. Sir, whenever the examiner give you the data of spot rates or forward rates of different maturity, what is that presentation of data called as? That is called as yield curve, spot yield curve, or forward yield curve, or it may also be called as term structure of interest rates, right? So that everyone in the class is spot versus forward interest rates. Now I'll tell you the first topic which you will now create the concept. I will not teach you, you will create it, and we will together apply it in the practical question, valuing the bond using spot rate. Imagine that I have a bond having a life of 3 years, which means for the 3 years I'll receive coupon, and in the third year I'll receive the redemption value as well. Sir, the basic fundamental principle of valuation remain the same. Value of the bond today is the present value of future cash flows. But now to do that present value, now to do that discounting, examiner has not given me YTM, it has given me the spot rates. Do you agree spot rate requires every maturity discounting to happen using that particular rate? Which means if there is a coupon at the end of first year, it has to be discounted at the rate of 5% for 1 year. The second year's coupon will be discounted at the rate of 5.5% for 2 years. The third coupon and redemption value will be discounted at the rate of 60% for 3 years. Could you connect to my point that I'm trying to teach? Because second year's cash flow can be discounted only and only using 5.5. Third year cash flow can be discounted only and only using 6%. Requesting your response. Could you connect? So now I'll say coupon of first year to be discounted at the rate of 5% 1 year. Second one is 5.5 for 2 years. Third one is 6 for 3 years. Your learning when is converted into a mathematical equation, how does it look like? Sir, coupon of first year divided by 1.05 to the power 1. Coupon of second year divided by 5.5 to the power 2. Third year is 6% for 3 years. That's how it is mathematically given. In fact, simply 1 plus r to the power n. Just then r for respective coupon is different because for respective period it is different. Or you can also think it at coupon into present value factor at the rate of 5% 1 year. Second coupon into present value factor of for 2 years at the rate of 5.5%. Then third year factor at the rate of third rate. Correct? That's how the valuation is done. Let's do a practical question on this and then you'll be able to connect. Sir, let's solve this particular question. Question number 18th in the class. Super ultra fast. Let's do question number 18th in the class. Boss, ABC wants to issue 9% bond redeemable after 5 years at a face value of 1000 each. The annual spot yield curve, which means the spot rate given in the question is that for 1 year, the rate is 12. For 2 year, rate is 11.6234 something. 5 year rate has been given. And my bond's life is also 5 year. Life is sorted. Cool, sir. Evaluate the expected market price if the beta value is 1.1. Ignore this concept of beta value. It is the point of learning in this question. For now, if I ask you to calculate the intrinsic value, how will you do it? Present value of future cash flows. Let's imagine the future cash flow, 9% is the coupon rate, bond face value is 1000. So 1000 into 9% give me 90 rupee of coupon to be received in the next 5 years, and last year I'll receive 1090. First 90 is to be discounted at the rate of 12%. I have to use the present value factor for 4 digits after the decimal point. So can I say first 90 into the present value factor at the rate of 12% for 1 year? Second 90 at the rate of 11.62% because that is the rate for second year. So at the rate of 11.262%. If I discount it for 2 years, I'll have to consider the present value factor of 2 year. Then at the rate of 11.33%, I have to discount it for 3 years at the rate of 11.06 for 4 year and at the rate of 10.80% for 5 years. Sir, do you agree? This 90 can be made directly 1090. Why do you need to discount 90 separately and 1000 separately? Let's remove this step and let's make this cash flow to be 1090 only. Aligned, sir? Agreed, sir. Settled. Sir, math is secondary. Math is secondary. My question to you is imagination of the concept, application of it to the practical question, and creation of this mathematical equation using that concept. Is that done, everyone in the class? Please respond to me, then I'll take you ahead. Come on. Is that done, people in the class? Please respond to me. What do you all say? Happening? Sir, how do you solve it is now a simple thing. Sir, 1.12 divide equal to, give me the present value factor of 1 year, first year. 1.1162 divide equal 2 times. Give me 0.8959 on a rounded off basis being the present value factor, right? And then everyone in the class is how you discount everything and you get the present value being your intrinsic value as 929, right? Sir, they have asked me to calculate the expected market price, and now is the point of learning through this particular question. Listen to me. Sir, whenever beta value is given, you have to first calculate the intrinsic value. And then expected market price, this is a small concept, please remember, is intrinsic value into the beta value. Meaning to say, according to me, present value of the future cash flow is 929.66. Yes, sir. To that, if you multiply beta value, you get what is the price that prevails in the market. The price in the market is 1.1 times of its intrinsic value. Sir, is there a logic to it? Not much, but please accept it for the sake of doing practical question, that this is how you calculate the expected price using beta and intrinsic value. Could I deliver this particular concept to you? Could I deliver to you how do you value a bond using spot rate? Now the next thing. Sir, if we have been given the spot rates, then using the spot rate, can we find the forward rate? Everyone in the class? Do I have the permission to go to the next concept? Please tell me. In this question, people, In this particular question, the second part is theory. You'll have to do it at your own. I will now take you to the second concept. What have you learned? Please confirm it to me. Can I take you all ahead to the next concept? Next 15 minutes, the entire topic will get done. The invisible forever. I remember you attending, I guess, my English videos, but I don't remember your name. Theory chapters, English revision, I don't think there is a live need to do it. In the revision video playlist, you will observe that the theory playlist, the theory video is there. From that marathon, you can completely revise it. Okay? From that marathon, you can completely revise Hindi theory chapters. सारे जो 4 important chapters हैं उनका revision आपको वहां मिल जाएगा. And English people, for your information, the playlist also has the English revision video link. Theory for theory chapters. Cool. So now you learn the next thing. Sir, first thing we learned was difference between spot and forward. Then we learned valuation using spot. Now we will learn that if you have the spot rates, using that can we find the forward rates? Hello? If we have this spot rate and this spot rate, can we find this particular forward rate? Or if I have this spot rate and this spot rate, can we find this particular forward rate? The answer is yes, that is what you are learning. And after that, you will learn if we have been given only this forward rate. If I have been given 1 year forward rate for every year, 0 to 1, 1 to 2, 2 to 3, 3 to 4. If I have been given all these forward rates, can I value the bond? Will be our next and the last learning related to this topic. Sir, let's proceed ahead. I will say calculating the forward rate using spot rate is really simple. Imagine that 1 year rate has been given as 5%. Please pay attention. This is the concept. This is the illustration. We won't do a practical question on this because there is no need. That simple it is. Imagine that first year spot rate, 1 year spot rate is 5%, 2 year spot rate is 5.5%. Using this, can I calculate the forward rate of 1 by 2? The answer is yes. So first conceptual clarity, if you need the forward rate of 1 by 2, you need the spot rate of 1 year and 2 year. If you want to calculate the forward rate of 1 by 3, then you need the spot rate of 1 year and 3 years. Start date and end date has to be your spot rate. Start date and end date. Cool, sir. How do you calculate it? Really simple. Sir, if I stand at 0 point, if I have imagine 1 rupee to invest, I can invest it in 2 ways. First option, I can invest it at the rate of 5% for 1 year because spot rate is of 1 year. Then using that forward rate, I can further invest it for a period of 1 year. Agreed, and that's how I will have a future value. Aligned, sir. Or another option is to invest that 1 rupee using the 5.5% directly for a period of 2 years and get the future value. Agreed, sir. This future value, people, those two future values should be equal because my period of investment is 2 years, which is same. If the time period of investment is same, the risk involved is same, and ultimately the return I should be able to earn should be same, and ultimately my future value should be same. Aligned, sir. Now let's try to give the effect of this understanding to the math. What is the future value as per this path? It will be 1 rupee invested for a period of 1 year at the rate of 5% is 1.05 to the power 1. If it is for 2 years, I'll make it 2 here. Cool, sir. Right now it is for a period of 1 year. Okay. Then again at the rate of forward rate. So 1 plus forward rate into 1 by 2. Forward rate 1 by 2 means for a period of 1 year to 2 year. So 1 plus forward rate again to the power 1 because my amount again gets reinvested only for a period of 1 year from year 1 to 2. So that I get the future value, and this future value, people in the class, I know should be equal to this future value, which is 1.055 directly to the power 2. Because at the rate of 5.5%, I can make the investment directly one shot for 2 years. Do you people have a comfort on creation of mathematical equation from the timeline driven concept that we have learned? Solving is secondary for me. For me, the primary is creation of math from the concept. Come on. Requesting your responses, please. Are you able to equate the two future value? Are you able to connect the future value of one path should be equal to future value of another path? That was the core of, that is the main part where you convert your concept to the maths. Yes or no, requesting your responses. And now I know. Now let's apply the maths. Now I know the only number that is missing in this entire equation is the forward rate. How do you solve it? Sir, take 1.055 on your calc sheet into equal to solves this. You divide it with 1.05, right? Since it is to the power 1, it has no value. It's like now I get 1 plus forward rate to the power 1 is equal to 1.600. Deducting this one, let's get this 1 to the RHS deduct as minus 1 give me 6.00 into 100 gives me 6% per annum as the forward rate for the period of 1/2. Requesting your responses, could you connect to me on this? People, please tell me. Could you please connect to me on this? I need a validation using spot rates. Could you learn to calculate the forward rates? Boss, what do you all say? You got it? The same thing you apply to any given question, which is why we are not solving the practical question. We are not solving the practical question on this particular concept because it is the copy paste thing that you apply, right? The next thing you are learning the valuation using forward rate. A very easy concept. In the next 5 minutes, the concept gets done and then we all proceed to take a break. Yes. So let's learn. Sir, imagine that I have this time been given the rate from 0 to 1, the rate forward rate from 1 to 2, the forward rate from 2 to 3, and the forward rate from 3 to 4. And imagine that there is a bond whose life is 4 years, for example, which means I will receive the coupons for 4 years and I will receive the redemption value as well in the fourth year. Cool. The basic logic remains the same. Value of a bond as the present value of future cash flow, which means the fourth year, third year, second year coupon, all of them have to be brought to zero value, 0 point. Correct? Fourth year coupon, if I want to bring it to 0 point, then do you agree? We don't have the spot rate of 4 year which can directly bring it from 4 to 0. We have rather the forward rate which can bring it from only 4 to 3. So no problem. Can this cash flow of coupon and redemption value be brought from 4 to 3 using this discounting rate? Whatever is the discounting rate, can you bring it from 4 to 3 by discounting it for 1 year using that particular rate? Then the same cash flow, people in the class, using this particular rate of 3/2, can the same cash flow be further discounted for 1 more year using this particular rate? Can it be further discounted for 1 more year using this particular rate of 1/2? And can this be further discounted for 1 more year with the rate of 0 to 1? Which means, can the cash flow of fourth year be brought to 0 year by discounting it by 4 different rates and brought to 0 point, first from 4 to 3, then from 3 to 2, then from 2 to 1, then from 1 to 0? Requesting your response, yes or no. Similarly, cash flow of 2 year will be first discounted. Now we have the cash flows as rate as well. Second year bond is there. I will first discount it with 1.06, bring it from 2 to 1, and then I will discount it at the rate of 5% divided with 1.05 to bring it from 1 to 0. That's simply the forward rate valuation, people in the classes. If the cash flow of first year is there, we discount it using 5% for 1 year. If the cash flow of second year, it will be first discounted at the forward rate of 1/2, which 6% that we just calculated here, 6% that we just calculated here. So using the rate of 6%, it will be discounted for 1 year and then further discounted for 5 year using the discounting for spot rate of 0 to 1. Sir, imagine it. Coupon of first year divided by 1.05 to the power 1. Coupon of second year divided by 1.06 to the power 1, bringing it to 0 from 2 to 1, and then dividing it to by again 5% to bring it to 0. Coupon of third year will be divided first using the forward rate of 2/3, then by 6%, then by 5% for respective years. Requesting your responses, could you connect the valuation using forward rate? If yes, I'll immediately take you to a practical question of it. Come on. So that timeline imagination of spot forward was so important that with that imagination, now you're 100% are finding this topic really easy, and not just easy today, retainable for a longer period of time. Am I right to say so? So let's do a practical question application of this. I will now say, let's do practical question number 21. An extremely easy question. It says that there is this 8% 5-year bond of 1000 rupee face value having maturity 3 years. Sir, if 5-year bond, then okay, time to maturity now is 3 years. The time left now is 3 years. I have to discount the future cash flows of 3 years. Present rate of interest is 12% for 1 year tenure. For a period of 1 year, rate of interest is 12%. Can I say it to be the spot rate of 0 point? Yes, sir. It is expected that forward rate of interest for 1 year is going to fall by 75 basis point, which means after a year, because for the first year rate is this, for the next 1 year rate is going to fall by 75 basis point, which means 12 minus 0.75 give me 11.25, and further by 50 basis point for next year. So sir, if you imagine it on the timeline, sir, rate for the first year is 12, for the next 1 year it is 11.25, and next 1 year it is 10.75. So I have to bring from this cash flow from here to here, right? So I have to first find the intrinsic value. Imagine the cash flow. 8% coupon rate on 1000 rupee face value is 80, 80, 80, and third year has the redemption value of 1080 as well, of 1000 as well, making the total cash flow to be 1080. First cash flow of 80 is to be discounted by 12 for 1 year, life is sorted. Second 80 will be discounted at 11.5 to 11.25 and 12% for 1 year each. Third 1080 will be discounted at the rate of 10.75, then at the rate of 11.25, and then at the rate of 12% for 1 year each. Requesting your response. Math to me is secondary. First to me is creation of this mathematical equation using the concept you have learned and being able to interpret the question. These are my primary requirements from you as of now. Come on, everyone in the class, what do you all say? Come on, people in the class, what do you all say? Yes, no? Come on. Now, to be able to solve this is not a big deal. 80 divided by 1.12 m plus. 80 divided by 1.12 divided by 1.1125 m plus. 1080 divided by 1.12 divided by 1.1125 divided by 1.1075 m plus. Memory recollect give you this answer. This is a simple mathematical way of doing it. Yes. Yes. And once you have the intrinsic value, how do you calculate the expected price? Sir, multiplying it with the beta, the thing that we have learned in one of the previous question, doing it again. Intrinsic value into the beta give you expected price. That simple is the question number 21, which involves calculating the value of a bond using forward rate, and this entire section people in the class gets done. What have you learned? What are spot? What are forwards? How are they being used for the purpose of discounting? How are they different from YTM? Then you learned valuation using spot. Then you learned calculating of forward using spot. And then you learned valuation using forward. This entire thing people in the class gets done. And now I think we deserve to take a break, because around 50%, more than 50% of the content of this chapter is done. You may feel the lecture to be extended, but this is the fastest we can do without compromise of quality. Otherwise, if I do it faster, you're not learning the things effectively, or you're not learning everything. Now, at least I'm sure that I'm teaching you everything which is needed in this chapter, on which the practical questions has been asked by the institute in the past exams. Yes, boss. So now we all take a break. How long break do you want? With an expectation that you will need to devote around 2.2 hours or 2.5 hours after the break. Then only you have a complete confidence over the chapter. 15-minute break, boss. 11:41 it is right now. Let's meet back at 11:55, 56 kind of. But please make sure you come back a reminder that we don't need to be motivated for the moment. We have to be driven and determined every day, every moment, every hour. And you all need to be there with me till the end of this lecture. Yes, that's when you will feel satisfied during that second revision, during those 1.5 days, that thank God I learned it really well. Yes. So got everyone. Bye bye. I'll see you all up to around 15 minutes. 11:55, 57 kind of. Bye bye. Yes, people. Are you all there? Back, please, everyone. Shall we all proceed with it? So now. Are you all there? Back, everyone, please. So sorry for the delay. Actually, a bird by mistake entered into our drawing room. So I think there was another bird attacking to that small bird, and they were fighting, and then somehow they entered into our drawing room. And the bigger bird flew away, and the smaller bird is now in our home. So just was there for the 2-3 minutes to understand what was happening. Yes, boss. So we have to now start with refunding decision in bonds. What do you have to start with? Refunding decision in bonds. Very interesting topic, right? Very confusing to a lot of students, but if we are able to do it, understand it with clarity, the topic become easy, right? Let me open my latest OutNotes, which means the one that I'm using in the latest full English regular batch which is going on. Give me a second. Let me go there. Here it is. Let's practically imagine what's happening, right? Theory chapters problem part as in Shifa. You type in the meantime, let me continue the thing, then I'll answer your question. Sir, at 0 point, which means actually I stand here at 0 point. 5 years back, I had issued the bonds in the market. The face value of the bond was 1000. Suppose the YTM in that during that time was also 14. So I kept the coupon also 14 so that I can issue the price at its face value. Do you connect to what I said? I just said I you remember me explaining if coupon is equal to same as YTM, then the face value of the bond will be equal to its the face value of the bond will be equal to its issue price. So that is what we are trying to say. Suppose the coupon is 14% because YTM was also 14. So the face value become its issue price. Fine, sir. Agreed, sir. Aligned. Suppose there were 30,000 bonds issued when 30,000 bonds were issued at 0 point. All right. Now it's been 5 years. This is where I stand now. And this bond is a callable bond, which means it has a feature that, just a second, the bond is a callable bond, meaning to say it has a feature that a bond can be bought before redemption. A bond can be redeemed before redemption. Sir, do you people remember this discussion? Do you people understand the concept of buyback in equity share? As a company, there are equity shares that are issued. If I want, I can buy those equity shares back and pay you a price against it. Very similarly, generally the redemption happens on maturity, which means the issuer of the bond will pay the redemption value to the bond holder, and bond holder will give his bond back to the issuer. But if this is a callable bond, the company has an option to redeem the bond before maturity. So that is what the concept background is. Now we have to decide, should we at this point redeem that older bond and issue the new bond? Or should we at this point continue to follow or continue to use or continue the existing bond? Sir, how will your decision be taken is a very simple thing. At 0 point, which means 5 years back, at 0 point means 5 year back, when the bond was issued, the coupon rate was 14 because the YTM was also 14. In the market over the time as the YTM changes, now at this point the YTM has become 12. But how much is my coupon? The coupon still is 14 because that gets decided at 0 point. Now y'all, everyone in the class, imagine this. At this point, I have two choices. Either continue with the older bond, and continue to pay the coupon of 14%, or choice number two is retire the old bond, which means refund the old bond or redeem the old bond and issue the new bond having 12% coupon rate. Do you people understand the logic that now in the market, if YTM is 12, if now I issue the new bond just by keeping 12% as the coupon, I'll be able to, issue the bond at equal to as face value, right? So now to generate 1000 rupee, I don't have to pay 14%. I can continue to pay only 12% for the next 25 years, which are left to it. Yes. And that is what the question is. Should you continue the old bond and pay 14% of coupon for the next 25 years? Or should you retire the old bond and issue the new bond and continue to pay only 12% for coupon rate for the next 25 years? Requesting your responses. Is the concept clear? Please tell me, everyone. Yes or no? Come on. Super ultra fast. The decision to be taken is this. How do you take that decision? I'll now explain. People, what do you say? Hello? Yes, the decision to be taken is clear. And we can sense that here the coupon cost is more, here the coupon cost is less. So you might think one should obviously follow this. But then you do this, it has some cost associated to it. For example, when I issue the new bond, for that I'll have to retire the old bond. So it may happen that old bond is needed to be retired at a price more than face value. Imagine that a old bond is to be retired at a price of 11050, which means that is the call price. The price at which a bond is retired or called before maturity is call price. So 1150 is the call price. So do you people agree that 150 rupee extra you will have to pay on the retirement of old bond, because new is issued at 1000, old is retired at 1150. So 150 is the additional cost here. When you retire the old bond, issue new bond, you'll have to incur the flotation cost of the new bond, right? Plus there would be some other income and expenses associated to it. So do you agree that the decision is not very obvious to compare the 14% coupon rate? We have to compare all the associated inflows and outflows related to this. So sir, what is the way to do this? It's really simple, right? At this point you stand, in your imagination you do this, that if I do this, what are the inflows and outflows I will have to incur. So do you agree if you continue the old bond, you have to pay the coupon at the rate of old bond? Yes sir. Plus sir, when I issued the old bond, there was some flotation cost or discount that I incurred, है ना? 5 years back I incurred some flotation cost. Is that of relevance now? Is that cost of relevance? Is that cost of any relevance now? The answer is no. Why? Because that is a sunk cost that is already incurred. Even if you retire or you continue, whatever you do, that cost is not going to get reversed or anything. Do you agree? Fine. Sir, however, if I retire the old bond and continue the new bond. So one second. I'm going back to the alternative one. Related to this alternative, imagine all the inflows and outflows for the next 25 years. And then discount all those inflows and outflows to present value at this point. Similarly, in case of alternative 2, imagine all the inflows and outflows for the next 25 years and discount all the inflows and outflows for the next 25 years and bring them to zero value. Are you all, everyone in the class, understanding my point? Hello? And do you find it to be a common sense that whichever alternative has lower present value of cash outflow is a better alternative to do. Isn't that a very simple decision you have to take? Come on. Hello, requesting your responses. It is as simple as, suppose you start from Mumbai. You left Mumbai, you have come to Delhi because initially you planned to go to Leh, right? Leh Ladakh. You left Mumbai to go to Delhi to for Leh, and you have come to Delhi. When you come to Delhi, someone suggested you can drop the plan of Delhi. Sorry, you can drop the plan of Leh, and now from here you can go to, say, Agra to watch, to see Taj Mahal. So from Mumbai to Delhi, I have come. All the cost related to Mumbai and Delhi has been incurred, has got no relation with my decision making. Now all I have to do is I'll have to check that if I go Leh, which was my original plan, what are the costs associated of traveling, food, hotels, everything. Option 2 is if I drop the plan of Leh and if I follow the new plan of Agra, what are the costs associated to ticket booking, hotel accommodation? If of Leh, if you get any refund, suppose you get the refund of hotel bookings of Leh, then that become the inflow in the second option. My second option is dropping Leh and going Agra. In this entire option, whatever the inflows and outflows associated, you consider them. And finally, figure out which of the two places has a lower cost of going, and that is where you go. Could you connect to the example that I've given here, everyone in the class? Very similarly, you have come to 5 year end. Whatever has been incurred is sunk cost. Now you have a choice that you can continue to go to Leh, which will have some cost, or you can drop the Leh, which means retire the old, and make the plan for Agra, which means issue the new bond, and related to dropping an issue, whatever inflows and outflows you have, that you consider in the second alternative, and whichever alternative has lower cash outflow, that's what you follow. Till this point, are you people 10 out of 10 settled? Requesting your super fast responses. Quick. Sir, so one inflow here is coupon of 14%, outflow here is coupon of 12%. That's done, sir. Then here there will be an additional outflow of call premium, meaning to say amount that you've 150, that 150 rupee extra that you have paid, that's an outflow today. The flotation cost that you incur, that's an outflow today. Coupon I have considered. Next thing, which is an outflow but is not considered, is the redemption value at the end of 30 year. Do you agree at the end of 30th year, which means 25 years from now? In both the alternatives, you will have to redeem the entire face value, correct? Since that is a common cash flow in both of these alternatives, and ultimately these alternatives will be compared, ICAI ignored this alternative in the suggested because that is anyway same in both of them. So ignoring it will give you the same decision, which is why since we want to align our solution with them, we have also ignored the redemption value. That does not mean redemption value is not a cash outflow. It is, but it is same, therefore ignore. So other than redemption value, what else will be the cash inflow outflow? That I will tell you with the help of a practical question. So let me open that practical question for you people now. The practical question for that we have to do here for this particular case is question number 25 asked in the attempt of September 25. Come on. Question says Tangent is considering calling means redeeming early 3 crore rupee of 30-year 1000 bond issued 5 years ago with the coupon rate of 14%. Sir, rupee 3 crore is the total face value. Face value per bond is 1000. So 3 crore divided by 1000 give me 30,000 as the number of bond issued 5 years ago. Since total life is 30 years, 25 years are yet remaining, the coupon was 14%. The bond have a call price of 1150. Today if you redeem the bond, then how much will you have to pay? 150 extra means 1150 you will have to pay, and had initially collected a proceed of 0.91 crores since 30 rupee discount was given on per bond. Sir, there are 30,000 bond into 30 give me total 9 lakh rupee of discount given. So from the total value of 3 crore, if you deduct 9 lakh, you get 2.91 crore as the discount. Sir, on the timeline, this imagination should simultaneously go on. What should the imagination that simultaneously go on? The imagination that should simultaneously go on is that discount of 9 lakh was given, coupon was 14, N was 30,000, and face value is 1000. Cool. Sir, is that discount of any relevance now? The answer is no, that is a sunk cost. Initial flotation cost was 390. 390 is initial flotation cost, that's also sunk. Company intend to sell 3 crore 12% coupon rate 25-year bond to raise the fund to retire the old bond. Now to retire the old bond, I will issue the new bond that will be issued at the rate of 12% coupon. Life will be remaining life of 25 years, right? And they are proposing to sell the bond at its par value. The face value is what they are planning to issue the bond. New bond will have a flotation cost of 4.25 lakh. Company's tax rate is 40%. After tax cost of debt is 8%. Cool, sir. KD given to be used as discounting rate. Now this is a point of learning. As the new bond must be first sold and then the proceed to be used to retire the old, the company expect a 2 month of overlapping interest. Let me guide you. In alternative two, where you think that okay, let's retire the old and issue the new. Do you agree? Practically, you will have to first issue the new bond so that you get the cash, and using the cash, you retire the old bond. Agreement or no? Using the old, hello, using the old, you can, 1 second, there's a comment I'll have to check. 1 second, what are you saying? There's someone who is this chapter about to conclude. No, we have 2 more hours left to conclude this chapter. And ICAN, what's your full name? If you're planning to join, then you can join, because the things that we will learn ahead has got no relation with the previous things that we've learned. Okay, so we'll continue it for 2 more hours and you can watch it. It will be worth, right? So people in the class, sir, what are saying? If you issue, you'll have to first issue the new bond. Whatever inflow will it be, using that you will have to retire the older bond. So when you retire the old bond and issue the new bond, there is a gap. You will have to first issue, wait for 2 months, and then retire the old bond. And this, when you do for a period of 2 months, you will have to pay interest even on the older bond. On the new bond, you will have to anyways pay interest for the 25 years on the new bond. But for that 2 months, you'll have to pay coupon even on the older bonds till they get retired. That is, sir, fine. They are asking, should you retire it or not? One point of learning that you particularly have to remember in this question is this concept of taxation which gets applied. What is the concept of taxation? Let me tell you. If you incur a flotation cost today, how much is the flotation cost on the new bond? 4,25,000. You get the tax benefit of it, because if there is an expense I make, then I get a tax advantage of it. Agreed, sir. How much is the tax rate? 40%. So in this question, although they have not specified that it is to be done, but you will have to remember it in the exam hall that the benefit of tax you don't have to take entirely immediately. 4,25,000 divided by 25 years gives me that every year the cost, people in the class, is 17,000. What is this 17? Is it an outflow of 17? No. The entire outflow of 4,25,000 happened today. But in my ITR, income tax calculation, I will show 17,000 every year for the next 25 years. I will not pay 17. Everything is paid at 0 point. But I will show 17,000 every year in the form of expense in my ITR in the next 25 years. Which means, do you agree that expense will go out today, but that expense will be shown in the ITR in the next 25 years, because of which tax will get saved in the next 25 years on that 17,000 rupee. Do you understand what is a specific point of consideration here in this question? Yes or no? Requesting your response. Come on. So when you show that 17,000 every year in ITR, showing 17 will save the tax of 40%, which is 6800. So 6800 will be annual tax savings on account of flotation cost that you will have to show in the next 25 years, which is actually all paid at 0 point. So cost initial outflow 0, but tax saving over a period of 25 years is what you will have to consider. Requesting your responses. Could I explain this? Right. So ICAN, what's your first name? That you have to tell me first, and let me tell you, maybe in the next 10 minutes you may not be able to connect because we are solving a particular question. After that, you'll be able to connect to me. Yes. Next, sir, So very similarly, when I paid 9 lakhs and 3.9 lakhs, the cost of discount and flotation cost were incurred today. But I must have planned to show it in my ITR over a period of 30 years. Yes, sir. So if I continue the old bond, will I continue to show these expenses in the next 25 years in my ITR? Yes. So in that case, will I get a tax benefit of it? Yes, sir. So if I continue the old bond, you have to consider three things. Paying the coupon at the rate of 40% and every year claiming 30% tax benefit. First, basic. Second, tax saving on the flotation cost. Flotation cost which was paid 5 year back. If I continue the bond, I will keep on showing that amount in my ITR will save tax, and tax saving on the discount of 9 lakh rupee which was initially given. If I continue this bond, this is what the case is. If I retire this bond, then now you'll be able to imagine the inflows, outflows. Sir, I have to pay the call premium today. Yes. I have to pay the flotation cost today. Yes. But I have to get the tax advantage of the flotation cost for the next 25 year. Yes. Sir, I have to pay the overlapping interest of 2 months. Yes. I'd have to pay the interest coupon at the rate of 12% for the next 25 year. Yes. Except for this point, I have explained everything. Now, if you get this, one way of presentation that I told you is that whatever inflows and outflows you have, you discount them to 0 point and find out which has a lower present value of cash outflow. But the way institute has done the presentation is slightly different, which is unfortunately more difficult, but I have to tell you that only for the sake of marks. If you have all the inflows and outflows, right, let's change the presentation slightly differently too. Let's first of all, from both of these alternatives, consider the inflows and outflows that happens on initial point, which means a 0 point. Then in another table, let's consider the inflows and outflows that happen over a period of 25 years, right? And then discount all the inflows and outflows of 25 year, bring them to present value, and then make the ultimate calculation. Sir, how will you make the ultimate calculation? Let me show that to you now, the entire thing. I'm now taking you all to the question. Sir, if I go to alternative 2 as compared to alternative 1, as compared to alternative 1, if I go to alternative 2, what are the initial outflows that will happen? Do you agree initially I will have to pay 150 rupee of call premium on 30,000 bonds? Since that call premium does not relate to new bond, it does not relate to new bond that it has to be for the purpose of taxation shown in the ITR in the next 25 year. It sir actually relates to the older bond. On that old bond which I redeemed, if I pay 150 rupee extra, since the bond does not exist in future, that entire benefit of tax I can take right now only. So on 30,000 bond at the rate of 150, when I show 45 lakhs of expense in my ITR, I get 30% benefit. How much? 30 or 40? 40%. 45 lakhs minus 45 lakhs minus 40% give me 27 lakhs as the cost after tax that I have to incur today. So it is the after tax call premium paid. It's an outflow that is after the effect of tax. Cool, sir. Cool. Initially, I will have to pay one more cost, which is the cost of the flotation cost of 4,25,000 on the new bond issued. Yes, sir. So what all have I considered? Sir, I have considered the flotation cost of today, extra that I have paid. Cool. Sir, I have considered the call premium today. Sir, why are you not considering this flotation cost paid 5 years back? Because it is a sunk cost. I have to only think as compared to alternative 1. If I go to alternative 2, what is extra I have to pay? So I have to pay call premium. I have to pay flotation cost, right? Is the tax benefit happening initially? No, it will happen over a period of time. Is the overlapping interest paid over a period of 25 years? No, sir, it is to be paid only today. So let's do it. So I will say on a principal of 3 crore rupee, for the next 25 year, I'll pay the coupon at the rate of 12%, which is new. But I will have to also pay it at the rate of 14% for the next 2 months. So on the older bond for a period of 2 months, when I pay 14% on 3 crore, this becomes the amount of interest. But how much is the interest after tax? So post tax overlapping interest of 2 months on old bond at old coupon rate. I'm being very specific, which is how much? 3 crore into 14% into 2 by 12 into 60% give me 4,20,000 outflow. I have made this presentation of OutScanner way better and way specific by very clearly writing each and every word. If there is no adjustment of tax, I will not specify it. If there is an adjustment of tax, I will specify it and I'll make it more. I will raise this level gradually. Sir, now these three things are clear. This one, let's ignore it now. I will teach you towards the end. So, sir, initially these are the outflows that has happened. Now, let's see what will happen on a per annum basis. Sir, as compared to alternative one, if I go to alternative two, right? First step one, was individually imagining the two alternatives. Imagine the cash inflows and outflows related to this. Imagine and cash inflows and outflows related to this. Once you have imagined the two alternative, where focus that alternative two is not issue the old. Alternative two is complete, retire the old and issue the new. I meant to say alternative 2 is not only issue the new, it is complete thing which is first retire the old and then issue the new. So inflows and outflows of both the transactions you have to consider here in alternative 2. Now ultimately what we are doing, comparing alternative 2 with alternative 1 to figure out what is extra in alternative 2. So we said in alternative 2 there is extra call premium, there is extra flotation cost, there is an overlapping interest. Now let's talk about annual savings. In alternative one, you were paying 40, but in alternative two, you will pay 12. So is there a saving of 2%? Yes, sir. So please pay attention. Of this 3 crore rupee, when I save 2%, every year I save this, but I have to pay the tax. So net effect, net benefit to me is only 60%. So 3 crore into 2% into 60% is 3,60,000. I save every year for the next 25 years. Cool. Then, sir, again logical. On the older bond, my flotation cost was 39. Flotation cost was incurred here. But do you agree? For the purpose of ITR, I was showing it every year. So I must be giving some tax benefit, right? Similarly, the new flotation cost is 425 that I pay here. The outflow happened at 0 point, but my concern is the tax benefit that I get for the 25 years. So when I pay 390 of flotation cost divided by 30, 3,90,000 divided by 30 gives me 13,000 of flotation cost that I was having in the previous case, right? In the new case, I have 4,25,000 divided by 25 give me 17,000 of flotation cost per annum to be shown in the ITR. When I show 17, how much is the tax saved? 40% of it. Please understand there is a difference. I don't need 1 minus 40. 1 minus 40 is the expense amount after tax. Is the amount of expense after tax. I don't need the expense amount after tax. I need the tax amount itself. I need that 40% component itself. So 17,000 into 40% when gets saved every year, it becomes 6,800 saving in case of new bond, whereas 13,000 into 40% give me only 5,200 saving every year. So in alternative one, where I paid a flotation cost, that was giving me a saving of 5,200, but now paying 425 give me a saving of 6,800. How much is extra saved tax for the next 25 years? 1,600. Boss, requesting your responses. Could I explain this question? The pointers that are coming this question, am I able to explain them? Then, sir, in the previous case, there was a discount of 9 lakh rupees given. That discount is to be amortized over a period of 30 years. So if you follow this option, how much is the tax saving? Sir, 9 lakh divided by 30. 9 lakh divided by 30 years into. Please observe it as 30 years, huh? For this bond, every year found is to be found dividing by 30. For this, every year is to be found divided by 25. So 30,000 into 40% gives me 12,000. I was able to save an alternative one in the form of interest, in the form of tax on discount. In the second alternative, there is no discount. So will you be able to show anything in the ITR? No. So in that case, if there is nothing to show in the ITR, will you get any tax advantage? No. So I will say 9 lakh divided by 30 years into 0.4 give me the of tax saving of 12, which was having an alternative 1 but not having an alternative 2, which is a loss to me, outflow to me. It is a loss of saving. 360 was the saving in the interest as compared to 1412 was saving. Similarly, second point on flotation cost, tax was saving, but in case of discount it is a loss because alternative 2 had the saving, alternative 1 sorry, alternative 1 had the saving of 12,000 in tax. Alternative 2 has not anything of this sort. So now I will say, if I talk about annual inflows and outflows, I have the interest coupon saved every year, tax on flotation cost, tax on discount lost, which is 349 net of everything for the next 25 year at the rate of KD. When I discount it with the annuity factor, right, it becomes the present value of saving as 37,31,980. So next 25 year, the present value of whatever I save in the next 25 years is 37,31,980. And to go to alternative 2, this is an advantage. But what have you paid extra when you go to alternative 2? Sir, what I've paid extra is in the first table, paying the call premium extra, flotation cost extra, 2 month of overlapping interest extra. And one more thing that I have to explain is something out of the box, a hidden adjustment, you can say. Why is it out of the box? Let me explain you. Boss, very simple. Do you agree when you go to alternative 2, which says retire the old bond and issue the new bond? Sir, in this alternative, when I retire the old bond, will this discount and flotation cost? Sir, this discount and flotation cost that was paid at 0 point, that is sunk. But the tax advantage of it, I was planning to claim for the next 30 years. Yes, sir. For the first 5 years, I have already claimed it. And for the next 25 years, it is pending to be claimed. If I go to alternative 2 and if I retire those bonds, do you agree that unclaimed cost for the purpose of taxation, the unclaimed cost of 25 year can now be immediately claimed, because now that bond will no more exist. There is no point of amortizing it over the year. There is some cost which remain unamortized, which we can claim now. So 9 lakh plus 3.9 lakh give me the total cost into 25 divided by 30, give me what is the unclaimed cost of 25 years, which if I claim now, payment is not, payment happened 5 years back, the payment is a sunk cost. I just want to claim that, I want to show that entire cost of 25 year right now in the income tax, saving 40% to me. So how much is the tax saving? I'm not concerned about the cost. I'm concerned about that 40% part, which is the tax saving on the unamortized and flotation cost of the old bond, giving me a benefit of 430 happening today if I go to alternative 2. Boss, could I, everyone in the class, explain that considering all these inflows and outflows, right? Give me a second. Just give me a second. Just, I'm getting this call third time. Hello. Yes, people. So what were we saying? So do you agree that everything, all the inflows and outflows, sir, these were the initial three outflows, but there was a saving of 430 on the old bond that amortized when I wrote down. So initial outflow is 3115, but present value of saving of the future year coming gives me the final inflow of 3731. And that's how people in the class, I have NPV of the bond, means inflow, the saving minus the initial outflow, to be 616, and I will say therefore the bonds should be redeemed. I will say the final conclusion that the bond can be retired. 25th question particularly was an effort taking question. Could I succeed to explain this question to you? Please tell me. Could I, people in the class, succeed to explain it to you? Requesting your responses. Super fast, super fast. A question that institute has asked a lot of times. There was a point of difference. There is a hardness of explaining it. It takes effort for me to make it easy to you. Has that effort made sense? Could you understand what you have to do in this question? So if that is clear, bond reverting decision, people in the class, gets done. The next thing you have to now learn is the concept of risk management. Set are we? Perfect. So risk management concept, everyone, involves first calculating Macaulay's duration, also called as duration. That then involves calculating modified duration, also called as volatility sensitivity. That then involves doing convexity, and then it involves doing immunization. These four easy concepts, right? If you are able to understand that, the entire risk management will be done except for one more small topic called as immunization. Yes. So let's super ultra fast get started. Sir, duration, the concept of duration I'll explain through the practical question itself. Okay. Let me go to the particular question. Let's say this particular question, question number 31. Question number 31 will help us to understand concept of Macaulay's modified and convexity, everything. People, let's get started. The following data is available for a bond. A bond having 10,000 rupee face value is to be redeemed at par on maturity. Fine, sir. Face value is 10,000. Coupon rate is 8.5%. Time to maturity is 5 year and YTM is 10%. Basic details have been given to us. Yes, sir. You are required to calculate the current market price of the bond. Can I say this now become the easiest thing for us? The present value of future cash flows, the current market price. Cool, sir. They now ask you to calculate the Macaulay's duration. And now I'm explaining to you Macaulay's duration. Please pay attention. If I ask you to calculate the price, how do you do it? Sir, coupon into the present value annuity factor plus redemption value into the present value factor, you get the price. Yes, sir. But now I'll explain you how do you calculate Macaulay's duration. So whenever examiner asks you to calculate Macaulay's duration, modified duration, first you need to calculate the price, but not using annuity factor, but rather by discounting every cash flow in the form of a table. Sir, how do you manually create a table to discount the cash flows? Sir, 8.5 of 10,000 become 850 rupee of coupon. So I will receive in the next 5 years a coupon of rupee 850 and the redemption value of 10,000. Cool, sir. If YTM is 10%, let's discount each and every cash at the rate of 10%, right? And find the present value of all these cash flow, the total of which is the value of bond, which is 9431.5. Can I say till this point there is nothing new I have taught to you so far? Come on. Till this point, nothing new has been taught. Agreed? What do you say? Everyone. Agreed. Sir, now I'm teaching you Macaulay's duration. Please pay attention. What is the price of the bond that you pay today? 9431. And if I ask you the amount that you pay today, when are you going to get it back? When are you going to get it back? So you might think, sir, I'll get it back at the end of fifth year, but that is incorrect. Some amount you will get at the end of first year, some amount you get at the end of second, third, fourth, fifth. So that way, overall amount, your total you get at the end of fifth year, but over the time you start to get some amount, right? So my question to you is, how much is the weighted average time taken for you to get your amount back? How much is the average time period for you to receive your amount back? So now I'll have to calculate average. But please pay attention. Do you agree this 850 rupee that you received at the end of first year? This cash flow of 850 that you received at the end of first year. So sir, amount you received at the end of first year is a future value. If the amount I paid in today's terms, then I will have to check in today's term how much I receive back. So 850 if you received at the end of first year, then the present value of it is 772, which means in today's term, the value of cash that you received at the end of first year, in today's term, the value is 772. At the end of second year, whatever I received in present value terms, its value is 702. And similarly, the value for the cash flow of the next 4 year, that 3 years that I received is 638, 580 and 6737. So now I change my equation. Now I change my statement. That amount that I pay today, which is 9431, I recover over a period of years, not as this, but rather as this, because the future values that I receive when I bring them to present value, this is how I have received my present value of 9431.5 back. Cool. Now the question is, if these are the amounts you have received at the end of year 1, 2, 3, 4, 5, right? And that's how you received your total value of 9431 back. How much is the weighted average time taken? So really simple. This is my year and this is my weight. Year into weight gives me the weighted average time taken to recover back the amount. I will say first By the end of first year, 772 gets received. By second year, 702 gets received. By third year, 638 gets received. So the weighted average is year into weight is this particular column. How do you do the weighted average? Simple. Simple. Year into weight, the total you take in the numerator, and denominator you take sum of weights, which is sum of DCF, which is 9431. So numerator is multiplication of year into weight, denominator is sum of weight itself. So 40103.35 divided by the sum of weights, which were my DCF, which is 9431.5, which is the value of the bond, give me 4.252 years as the weighted average time taken to recover the total value of my bond back. I'm trying to teach you in a manner that you don't have to mug it up as a formula. You have to take it as a concept that, okay, this value being paid today is recovered over the years in this manner. So overall, how many years it take to recover on an average this total value? It is 4.252 years. People, please respond to me on this particular point. Could I succeed? Yes, yes, yes. Come on, super fast. Could I succeed in doing so? What do you say? Yes. Sir, but we have learned the weighted average in percentage terms. That's also one of the ways. Some people assume this DCF total as 100%, and then they convert these individual amounts into weights in percentage weights, that how much of an amount, what percentage is recovered by the end of which year, and then ultimately you say by the end of first year the cash flow that got recovered has this weight, second year has this percentage weight, third year has this percentage weight, and ultimately the weighted average turns out to be 4.252 only. The same answer. This is the weighted average time taken to recover the cash flow of the bond back. So that is what Macaulay's duration, people in the class, is the weighted average time taken, right, sir? Now there is no need to explain it again in terms of concepts. You can go through it if you want, but as I said, there are two ways to do average. One is multiplying your year with the DCF, where DCF become the weights, right? Another way is to convert these DCF into percentage terms. How much is 47.2%, the first discounted cash flow as a percentage of 1000? Sir, 4.76. How much is 453? 4.54. So that's how you have the percentage weight. So another choice is you do year into weight, year into weight, year into weight, year into weight percentage terms, and the ultimate answer will be same. You can follow this if you want to save the time of one column. You can follow this so that you don't have to create the weight column. You can directly with this column find the Macaulay's duration. Done. So that was people in the class Macaulay's duration. What is modified duration? Really simple. Whatever is your Macaulay's duration, whatever is your Macaulay's duration, that divided by YTM, you can ignore this K right now. This K is what has not been tested in the exam much. It is only once in the last 26 years I could find a question. Except for that particular question, we can say simply whatever my Macaulay's duration I've calculated divided by 1 plus YTM is the divided by 1 plus YTM is the modified duration. For example, in this case, if Macaulay's duration is 4.252, right, and modified and YTM is 10%, so 4.252 divided by 1.1 give me 4.252 divided by 1.1 give me 3.865 as my modified duration, also called as volatility or sensitivity. Again, at this point, I need your validation. Could you understand me? Requesting your responses, please. See, you don't have to say yes. You can say no, but if you say, I get an idea of whatever I'm explaining, could I deliver it to you? Hello? Hello? Everyone in the class? Settled? Are we? Can we go ahead? Are you all able to connect to me? Sir, modified duration has an interpretation that it is a weighted average time taken to recover the cash flow of the bond back. Cool. What is similar interpretation of, sorry, Macaulay's duration has an interpretation as the weighted average time taken. Similarly, what is the interpretation of modified duration? Modified duration tells you a simple thing. Do you agree due to change in YTM, the price, the current market price of the bond changes? Yes, sir, it does change. What is the relationship inverse? When YTM rise, the price falls. When YTM falls, the price rise. This is the most basic thing we had read in the start. Cool. Sir, if the YTM change by 1%, if the YTM increases by 1%, will the bond price also fall by 1%? No, it will fall by the amount of Macaulay's duration, which is 3.865%. It will fall by the percentage of modified duration, not Macaulay's. It will fall by the percentage of modified duration, which is 3.865. So if the YTM falls by 1%, then bond price will rise by people in the class 3.865%. Is this the interpretation of modified duration? Answer yes. But what is the use of it? Common sense. If 1% YTM change gives you 3.865% bond change, then if my YTM change by, if 1% YTM change give me 3.865% bond change. So if my YTM change only by 0.5%, how much will the bond change by? People in the class, apply unitary, apply common sense. Can I say 3.865 into 0.5 give me 1.9325% change? Hello everyone. 1.9325% change. Do you all agree to it, everyone? Yes. So what is the application of modified duration? Sir, application is really simple. Once you calculate the modified duration, then using that modified duration, you can find the percentage change in the bond price for any given YTM change. If YTM change by 0.2, 0.5, 2%, 0.3%, 1.5%, any given YTM change can change. For any given YTM change, I can find out the change in bond price. And what was the simple way? What I've done here is I multiplied modified duration of 3.865 to the change in YTM of how much? 0.5. Against it, I can keep 0.2, 1.5, 2%. For any YTM change, if I multiply it with modified duration, I will get the percentage change in the bond price. Come on, requesting your responses. Are you people please settle? Tell me. So can you all, people in the class, please tell me, if in this case, if the YTM change by 2%, then how much will the bond price change by? Come on. If the YTM change by 2%, how much will the bond price change by? Meaning to say, if my YTM fall by 2%, bond price will fall or rise by what percent? That is the answer you need to give me now. Sir, so it is like 3.685 multiplied by 2 give me 7.37 percentage increase. So if the price right now is 9431.5, if the price right now is 9431.5, then plus 7.37% give me 10126 is going to be the revised price after the fall in YTM. After the fall in YTM, the price will be increased 7.73. So this is right now the price plus 7.73%. Give me 10126 as the revised price. That is an application of modified that we have learned, which is right now not asked. Then you have to learn the convexity. Convexity, people in the class, is a concept where you have to first look at it on the timeline. Give me a second. Give me a second. Give me a second. People. Sir, convexity, before calculating convexity, you actually need in total three values. What three values do you need? Simple. Imagine that there is a particular YTM right now, as we have learned 10% is the YTM. Imagine that coupon rate is also 10%. Then in that case, what will be the price of the bond be? It will be equal to the face value of 1000. Align, sir. To calculate convexity, you need to first calculate two more prices with an assumption. What is your assumption? The assumption is the change in YTM assumption. Meaning to say, If YTM increases by 2%, then what will the price be? Which means my YTM if become 10 to 12, then what will the price be? Then do you agree whatever future cash flows, imagine coupon rate is 10%, face value is 100, so 100 rupee of coupon, you will now discount at the rate of 12% for 5 years, right? And the redemption value of 1000 you will again discount by 12% for 5 years. Suppose when you do, the price that turns out to be is 9 to 8. And similarly, you assume the same decrease in the YTM. First, you assume the increase in YTM. So if I assume the decrease of 2%, then I will discount all these cash flow at the rate of 8%, and the price in the market will be 1080. Let's say, for example, once you have calculated the three different prices at three different YTMs, where first YTM is considered YTM 0 and the first value of 0 YTM is considered value 0. Value 0 matlab means the value that we initially had. Then with the increase in YTM, the value so arrived is called as V plus because it relates to the value at increased YTM. Although it is a lower value of 928 as compared to 1000, but the value is called as V plus. Similarly, the value that we have found at decreased YTM is called as V minus, even if it is a higher value of 1080. Once you have calculated the three values at 3 YTM, using it now you calculate the convexity. The formula, which is really simple. What is the formula? Formula says you add these two values. Which are the two values that you add? Let me one thing tell you. The concept of Macaulay's modified in convexity and immunization actually has a lot of depth to the extent that you can't even imagine, right? But exam focus is limited and a time that we have is also limited, which is why I have to explain it to you in a manner where I may not be able to convey to you the entire logic, but I'll be able to very well convey to you what is needed for the exam. And I hope that is what your preference at this point when you're watching it before your exams, right? So that is why I'm not explaining the entire background, but directly explaining to you what you need to do in the exam and how can you remember that. So you can remember that I need three values for three different YTM. We have to now find the change in the YTMs, a change in the value, which means I want to add V minus and V plus. And from that, I want to deduct V0. So I will add V minus and V plus, add basically this value and this value, from which I deduct V0, which means I deduct this value. So automatically I can find this change, right? So I have found a change in my price of both the sides. Can I divide it by 2 to find the average change of one side? Because this now considered both the changes. Dividing it with by 2 give me an average change of one side. Can I divide it with V0 to find the percentage change, that on a percentage, on a base of 1000, as a percentage of my initial price, how much, as a percentage of that initial price, how much is this average change? Yes. So that gives me percentage change in the average percentage change in the price of the bond divided by change in YTM square, which means due to this 2% change in YTM, due to this 0.02 square, how much is the percentage change in the YTM is the underlying logic behind the formula of convexity. That is what you need to find out. Are you all requesting your responses settled? Once you see how you calculated modified duration and then you applied it, very similarly, we have first learned to calculate convexity and then we will learn to apply it. That application is called as convexity adjustment. How is that application? Give me a minute. Let me have water, then I will explain that. How is that particular application? Give me a minute. All right, done. So we first calculated modified duration and then we applied it that for any given change in YTM we can find the change in bond price, right? The YTM change in this formula can be 0.2, 0.3, 0.6, any YTM change. Similarly, first you calculate YTM. For that calculated YTM, you have to take the change in YTM square as what you assumed to be your initial change, which is 2% in our case. Because based on that 2% change, the value change of numerator has been considered. So once you calculate convexity, people, after that you can apply that convexity for any given YTM change. You can apply it for the YTM change of 2%, 0.3%, 0.2% for whatever YTM change. Sir, Institute has rarely asked a question of convexity, and even if it is asked once, it has primarily people in the class tested the convexity calculation and not its application. In the just say for example they have asked for the volatility modified duration and not its application so far. Similarly, they have asked only for the convexity and not its application. But in e part of this question they have asked for the application of modified, that tell us the expected market price of the YTM fall by 200 basis points. So we will say when YTM fall by 200 basis points, then as per the logic of modified duration, the price will increase by 7.73% as you people calculated. Look at this. So 2% into the present modified duration will give you the percentage change in bond price. If YTM falls, then price rise by 7.73 and the revised price become 9431 plus 7.73% as this. Cool. B part of this question tells you calculate using intrinsic value method, right? Which is fine, which is not a big deal. But now let's learn to calculate the convexity. So in the course, we have to calculate only convexity, not its application. So convexity, people in the class, really involves first you have the YTM 0 and you have the value 0. Let's now increase the YTM from 10 to 12 and let's now decrease it from 10 to 8%. So accordingly, we will get the value which is going to be V plus, which is going to be a smaller value, and we will get V minus, which will be a bigger value, right? So if YTM is 12%, let's imagine this. If YTM is 12%, then coupon into the annuity factor plus redemption value into the factor at the rate of 12% give me overall value of 8734.25, right? 8734.25 is the value at V plus. Similarly, V minus. So now at 12% we already have the value. At 8%, what will be the value? We will say at the rate of 8%, when I discount the coupon and redemption value, the value is 10204.05. The value is 10204.05. So now this is V minus. So I will say V plus V minus V0 whole divided by 2 whole divided by V0 into change in YTM 0.02 square, right? So what become the formula? It become V plus, which is 8734, plus V minus, which is 1024204, minus 2 into the initial value, which is V0. Whole divided by 2 whole divided by 0.02 square give me the convexity, which is get calculated as 9.980 as the amount of convexity. People in the class, is the calculation of convexity clear to you all? Please tell me. Waiting for your responses. Come on, come on, come on. Everyone. Is the calculation of convexity clear to you all? What do you say? Hello, people. Bhavya, Bhagya, sorry, Shafa. Everyone else, Nilesh, others in the class, are we settled? Sir, if the convexity calculation is clear, then although the institute does not ask you to do the convexity adjustment, despite that institute has done the adjustment, right? That is something not fair on the part of institute. They have done the adjustment. So if so, first of all, practically, if you want to do the adjustment, institute should give you for what YTM change you want to us to do the adjustment. Is it the YTM change of 0.2, 0.3, 0.5? Which YTM change you want us to do the adjustment? Because here the YTM change is a different thing, which is based on this assumption. What I'm trying to tell you here, when you look at YTM change, here when you assume a YTM change, that is a different thing. That is the YTM change you assume to calculate convexity. Now is the YTM change they will have to give us to do the convexity adjustment. But sir, they have not given any YTM change. Then how do you do the convexity adjustment? Sir, unfortunately, the institute assumed the same 2% change even here. They assumed the same 2% change here and did the convexity adjustment calculation, sir, which was overall an illogical or an incomplete thing to do. So they have done the convexity adjustment as, please look at the formula of convexity adjustment as, sir, whatever is your convexity that you have calculated here multiplied by given YTM change square. It can be 0.2%, 0.5%, anything. Institute says convexity is 9.98 multiplied by YTM change of 0.02 assumed even if the question does not ask, right? Whole multiplied by 100. Sir, what is the logic of 100? Basically converting it from decimals to the percentage, right? So this involves some level of practice as well, like remembering things like converting it from percentage to decimal to percentage gives me convexity adjustment to be 0.399%. Sir, what is the ultimate use of convexity that I would not want to explain because we learn it in the class, frankly. We learn it in the class, but institute, this entire thing is the application, but institute has never asked it in any of its practical question. For example, part 3 is added by me in the class for the class students, right, as not the part of the original question I asked by the institute in the exam. Okay, so which is why application of convexity, since not being an institute's question, we are not doing, but calculating Macaulay's volatility and convexity, is it 10 out of 10 clear to every student sitting here? Come on, requesting your responses. People in the class, I need your participation. Could you understand this or not? What do you say? What do you say? Everyone, set are we? Clear are we? Settled are we? This is the peak in terms of difficulty, I would say, or in terms of effort that it takes to solve the question. This is the peak of fixed income. Now we'll start to again go down. We will go towards the easier and simpler concepts, right? This concept gets done. Fine. Just an MCQ question. From the risk point of view, Macaulay's modified, which tells you the risk, lower the risk, better it is. So which is why lower the Macaulay's duration, better it is. Lower the duration, less risky it is. Similarly, lower the modified duration, better it is. Fine, sir. Sorted, sir. Cool. Sir, now we are going to the next concept, which is the concept of immunization. Right? The concept of immunization, people in the class says what? The last topic related to risk management, then will be the easier things we have to do, sir. And then will be a brilliant out of the box explanation that will come to you after the concept of immunization. Sir, immunization says that imagine that I've created a portfolio today. Why? Because I want to use that portfolio to meet a future liability. Imagine that after 6 years I have to make an outflow. Suppose I want to do my higher studies, which is why I have an outflow to be made after 6 years. Where will I arrange that fund on after 6 years? So for that, today I have created a portfolio of bonds, right? Logic is when you create this portfolio of bond, what should the Macaulay's duration of this portfolio be? What is the question? Today, when I invest in a bond, what should the Macaulay's duration of this portfolio be? Immunization concept says that the Macaulay's duration of the bond should be equal to the Macaulay's duration of that outflow or of that liability. So if you need the funds after 6 years, which means you have an outflow to be met after 6 years, you should invest in such a bond whose Macaulay's duration should also be 6. So there are 3 bonds available in the market. One bond has Macaulay DR of 5, second bond has Macaulay's duration of 6, and another has Macaulay's duration of 7. In which bond will you invest between the three to keep your portfolio immunized? 6 is an MCQ, right? Now, suppose a bond which has 6 Macaulay's duration is not there. We have one bond with 5 Macaulay duration, we have another bond with 7 Macaulay's duration. Then how should you invest? You should invest on the portfolio of both the bonds. You should make a portfolio as the portfolio of both the bonds such that the Macaulay duration of my overall portfolio becomes 6 if the individual cannot become 6. Could you understand my point? The duration of the entire portfolio should become 6 if the individual cannot become 6. That is why it say Macaulay's duration of the bond or the underlying asset, sorry, of that asset of that entire portfolio should be equal to the Macaulay duration of the liability. What would examiner ask in this case? So I know that what is the Macaulay's duration of that entire portfolio? Common sense weighted average. Macaulay's duration of first bond into the weight of first bond. Macaulay's duration of second bond into the weight of second bond. So if I know that one bond has 5 Macaulay's duration, second bond has 7 Macaulay's duration, and I know that liability duration is 6, which means overall the duration of my Macaulay's portfolio, duration of my entire portfolio should also be 6. So the question that examiner will ask is that how much should the weights be? How much should the weight of bond A and B be such that the weighted average duration is equal to the weighted average duration of liability, which is 7. So in this entire equation, only one number will be missing, the weight, which you can reverse calculate. Can I take you to the practical question of this for you people to understand it? So let's go to the practical question. Question number 33 is the question of immunization, of which B part we want to do. In the A part, they have asked us to calculate the Macaulay's duration, which we are not doing again, directly taking the final answer of A part, that there are 3 bonds. What they say? That there are 3 bonds in a company. They have a maturity of 10 year, 8 year, 5 year. Their coupon rate is this. And in the first part, they have asked us to calculate the Macaulay's duration. So we have calculated them to be 6.86, 5.84 and 4.24. Cool, sir. Now the main part, part number B, that I want to teach you, right? Only this part particularly we want to do to learn the concept of immunization. It says that a bond portfolio manager has been asked to keep 45% of the portfolio money in bond A. So out of 100%, 45 you have invested in bond A. Fine, sir. Calculate the percentage amount to be invested in bond B and C. Then, one second, calculate the percentage amount to be invested in B and C that need to be purchased to immunize the portfolio. That need to be purchased to immunize the portfolio. Sir, if I have invested 45 in A, then in B and C, how much should I invest? That overall duration of my portfolio equal to the duration of my liability. If it is a question of immunization, in the question you will 100% find the duration of your liability. They are saying the following data is available. These bonds are used by a bond portfolio manager to fund an outflow scheduled in 6 years. Sir, you will never get, except for the question of immunization, you will not get the details regarding the outflow to be met. If the outflow details are given, then it is a hint that it is a question of immunization. So after 6 years, I have to meet an outflow, which means the duration of my entire portfolio should also be 6, right? So let's say I will say duration of first bond is 6.86, in which 45% has already been invested. Duration of second bond is 5.84, in which if the amount of investment is x, then duration of third bond is 4.24, in which the amount of investment is 1 minus 0.45 minus x. Do you get it, everyone in the class? Do you get this? The amount of investment is 1 minus 0.45 minus x, right? So that is why, and here you have to realize it's not 1 minus x. The sum of 3 was A plus B plus C is equal to 1. So C is equal to 1 minus A minus B. So A is already 0.45. We know minus B will give you that C. So in this entire equation now, mathematically you'll have to solve the value of X, which is weight of second bond is 36.31 and the weight of third bond is 18.69. So if you invest 45% in bond A, which is already invested, then if you invest in the other two bonds at 36.31 and 18.69, the weighted average duration of my entire portfolio becomes 6, which is equal to duration of the liability. And that is why I can say my portfolio is now immunized. Could I teach you what immunization is and what will this concept of immunization ask you for? Come on, everyone in the class, requesting your responses. Come on, come on, come on. So this concept of this entire section of risk management of bond gets over. And if this is clear, now I'll take you to a very easy topic, which is convertible bond terminologies and calculations. Very easy. I can bet there is a strong chance that you would have never learned this particular thing in this way, the way we will learn it now. Yes, so let's proceed. What does it say? It says that, what does it say? It says that, sir, if you are an investor, you suppose purchase a bond, a debenture, which is a convertible bond. Do you understand what is a convertible bond? A bond that can be converted to some particular number of equity shares. So there is this bond which can be converted to particular number of equity share, which is a convertible bond. How many shares can it be converted to? Suppose it can be converted to 20 shares. What is that officially called as conversion ratio? You don't have to remember the definition of any of whatever I tell you. You just have to know the understanding, the meaning in your brain. And through that meaning, you should be able to create the formula that we will do it in the class. Right? So let's start with the first thing. What it says that, just give me a second. Yeah. What it says that a particular debenture can be converted to some particular number of share called as conversion ratio. Then next, sir, if I purchase the debenture directly, it will cost me 1150. Cool, sir. Right? Sir, what is the price of the debenture today? 1150. Is it a CMP? If I convert that debenture into the shares, yes, sir, and if every share has a market price of rupee 55, then how much will be the value of one debenture after converting it to shares? Could you understand my question? How much will be the value of one debenture after converting it to the shares? In fact, if you can answer these questions, you will realize that you have learned them already. After converting the share, how much is the value of one debenture? Use your calculus and give me the answer. Sir, every debenture will be converted to 20 share, where every share is rupee 55. So 20 multiplied by 55 gives me 1100 as the value of debenture after converting them to shares. Aligned 10 on 10 on this, people in the class, tell me. 10 on 10 on this. So what is that 1100 officially called as stock value of debenture? It is the value of debenture, but in terms of stock, it is the value of debenture that is after conversion. So the conversion value of debenture. Yes, do participate on the next thing that I ask you. Sir, it is the stock value of debenture or the conversion value of the debenture? It is the value of debenture after converting it into the shares. Sir, these shares which is costing me rupee 55 if I directly buy. However, I did not buy it directly. I went to buy the debenture and then convert it to the share. Can you tell me? The shares which could otherwise be bought directly in rupee 55, now when I purchase debenture and convert it to share, how much is the effectively price? How much is effectively the price that I paid for every share? Can you answer it again at your own? It is everyone 1150 is the price I paid to buy the debenture. And every debenture which got me 20 shares. So the cost of buying 20 share effectively is 1150. So 57.5 effectively is the price of share when I bought it through debenture route. That is called as market conversion price, or only conversion price of the share, or conversion parity price of the share. So it is the price of the share, just that not direct but with the help of debenture route. Three terminologies have been taught so far. One debenture can be converted to how many shares is the conversion ratio. Then the value of debenture if I convert them to the share, and then the value of share if it is bought through the debenture conversion route. That's what we have learned so far. Agreed, sir. If you had a choice to buy the story is really important, because otherwise everything is a formula. In this story, you are going to learn 8 to 9 different names, 8 to 9 different meanings and formulas. If you understand it, which I will make sure that I explain. There is no point of mugging up anything. Now you people realize, did I have a choice to directly buy the share at rupee 55? Yeah. But did you buy them directly? No. You went through the debenture route and the price that you've paid is 57.5. Have you paid anything extra or have you paid a premium over and above at CMP? Yes, sir. You have paid 2.5 rupee extra, which is paying 57.5 as the effective price, conversion price, where the market price is 55 only. That 2.5 extra is officially called as conversion premium. Yes. And how much is that premium in percentage terms? We will say you have paid 2.5 extra as a percentage of 55, which is its market price. So 4.55 is what you have paid extra percentage terms. Logical, fine. But sir, why would you pay extra? Why would anyone pay extra? If the share is 55, why would someone pay 57.5? Because it has a logic that, sir, if you buy a debenture today, imagine the life of the debenture is 5 years. You will convert it after 5 years, for example. You will convert it, for example, after 5 years. Do you agree today if you buy debenture, the next 5 years you will get coupon on it? How much coupon you will get? For example, if the coupon is 10% on a face value of 1000, so the amount of coupon per bond become 100. Rather than debenture, if you buy the share directly, rather than debenture, if you buy the share directly, imagine the dividend company pay on every share is rupee 4. So let's now think about the income generated on these two different securities. Option 1, income on debenture. Option 2, income on share. What I get on debenture is 100 rupee of coupon. What I get on share is 4 rupee of dividend. But the two things are not comparable because one debenture give me 20 shares. So on a per share basis or equivalent to per share basis, can we find the amount of income in debenture or the amount of coupon in debenture? Sir, 100 rupee of coupon I get, which is against those 20 shares which I could have got, right? So 100 rupee of coupon if I receive divided by 20 give me 5 rupees the amount of coupon equivalent to every share. So 100 being the coupon amount on every share means divided with 20, the conversion ratio give me the coupon amount equivalent to every share is the income I get here, but the income on every share I get here is 4. Do you agree? Compared to share which give me 4 rupee of income, if I buy the debenture which gives me 5 rupee of income on an every share basis, I get 1 rupee extra, which is officially called as favorable income differential. Requesting your responses, could I explain to you favorable income differential of buying the coupon, getting the coupon as compared to dividend income? Yes or no? Requesting. So boss, now I realize that I paid 2.5 rupee extra as conversion premium for buying the debentures and then converting into the shares after 8 years rather than buying the shares directly. Why is that 2.5 extra? Because in debenture I get 1 rupee of income extra every year. Yes, calling it to be favorable income differential. So if I ask you that amount you paid extra is 2.5, that is the premium that you pay. And what you get back every year extra is 1 rupee. So how many years will it get for you to recover that 2.5 rupee extra that you've paid? How many years will it get? Sir, you simply calculate premium payback period, which tells you what you have paid extra is 2.5 divided by how much you get extra is 1 rupee. So in a period of 2.5 years, you will be able to recover back the premium that you've paid, called as premium payback period. The formula, common sense, you know, first and formula that you create, that is the conceptual clarity, that conversion premium that I've paid divided by favorable income differential per annum gives me the number of year for you to recover your thing back. So after learning conversion ratio, conversion stock value of debenture and conversion parity price, you have also learned conversion premium that you paid extra for share, differential income that generates extra income in bond as compared to share, and then the premium payback period. Are these 6 terminologies 10 on 10 people? Hello? So with these arrows, you are able to connect the things that, okay, comparing this with this is the conversion premium. Then comparing the conversion premium with the favorable income differential is the payback period. Comparing the income generated from these two securities give me the favorable income differential. Yes. Yes, perfect. The last two things. Sir, since this debenture has conversion option, which is why its value is 1150. Because what is its straight value? Straight value means the value of debenture assuming there is no conversion option. Assuming there's no conversion option, meaning to say, imagine the present value of coupons and redemption value. Coupon is 10%, redemption value is 1000. If you discount them at the rate of 9%, assuming there is no conversion, the value is only 1039. Then why is the value in the market 1150? Because people think that every debenture when gets converted to the shares, so if the value of the share rises, if the value of the share increases, then they will also receive a higher value. Then they will also get a higher value on the day of conversion. With that expectation, they are ready to pay a higher price today. Without that expectation, without the conversion, the price in the market is 1039, which is a straight value of the bond. Is that also clear? The last terminology that I explain is the premium over straight value. In the bond market prices this. In the market bond prices this, right? Over and above straight value, what is the extra price people are ready to pay in the market for this bond? Sir, over and above the present value of coupon and redemption value, people are ready to pay 1150 minus 1039 divided by 1039 gives me 10.68% extra is what people are ready to pay as a premium over straight value. Logic settled? Sir, last thing that I would want to explain to you is something called as percentage of downside risk. Do you agree if the price of the equity share will fall, people will feel that now we won't get this advantage from conversion, the value of the debenture will also fall. Correct. Sir, but it will not fall below straight value because even if the conversion route fails, even if we want to convert, don't want to convert, ultimately the redemption value is receivable, right? The redemption value and the coupons are minimum amount that is receivable, that gives me a minimum value of 1035. So that is the minimum price that can be achieved. So how much is the maximum downfall? From 1150 to 1039 is the maximum fall in the price as the percentage of 1039 and 1150, both you will have to calculate in the exam. So 1150 minus 1039 gives me fall of rupees 111. That 111 rupee of price, logically you feel it can fall from 1150. So divided by 1150 give me 9.65. And you also calculate divided with 1039 as 10.68% as the percentage of downside risk. Sir, I have explained to you in total of 7 concepts, right? 2 of which are more or less the same, but rest of them are unique. Could you understand all of them with a single story, making it easy for you to remember the things? Please tell me. Now, based on this, if we do a practical question, you'll realize that you're able to do that question at your own, where we first learn the concept, understand the concept and then create the formula of it. Question number 38 is what you have to do now. Come on, let's do it. Let's do it. And after that, I don't think it will take more than 35-40 minutes for us to do rest of the chapter. This is what I'm guessing. So let's do it. Let's do this particular question. Give me a minute. Let me have water. Because after which we are moving to the second section of this chapter, money market instruments, money market securities. All right. Yes, people. Shall we? Nilesh, we have to know that premium over straight value is surely calculated. Or we have to do one thing. Let's calculate the premium over straight value and percentage of downside risk both in the exam. On both the basis, first we calculate the answer uh, based on the CMP as base, and then we will calculate a straight value as base, so that examiner can take on whatever he wants. I am telling you what is to be done in the exam, not what is logical. Logical, premium over straight value, denominator should be this, and for percentage of downside risk, denominator should be this. Could I answer your question? This was logic. For exam, we have to keep both of them as denominator one by one. Let's do question 38. Following data, 9% fully convertible equity share into equity share the debenture at rupee 1000. Issued at 1000. Cool. Market price of this debenture is 1000 only. The conversion ratio is 25. Meaning of conversion ratio, one debenture can be converted to how many shares? Sir, straight value of the debenture. If there is no, see, what should the thought process now to solve the question be? When you read these technical things in your brain should run their meaning. Conversion ratio means one share, one debenture can be converted to how many share? Market value, straight value means without conversion option, what is the present value of coupons and redemption value? 800. Market price equity share 30, expected dividend per share 1. Conversion value of debenture or stock value of bond. Value of debenture only, directly it is 1000 given to me. After conversion, how much will it become? So sir, one debenture give me 25 share and one share is 330. So let's multiply the two things, give me 750 as the conversion value of the debenture called as stock value of the bond. Yes. Now create the formula. MPS multiplied by conversion ratio give me the conversion value. Conversion, market conversion price. First one was about the bond. So second one has to be about the share. Share can directly be bought at rupee 30. However, if you don't buy it directly, you can buy it through the conversion route. Meaning to say you can buy the debenture at rupee 1000 and convert them into 25 shares. How much effectively the price per share be? 1000 divided by 25 give me 40 rupee as the share price. 1000 is the CMP of debenture divided by conversion ratio give me 40 as the market conversion price. Conversion premium per share. C part is conversion premium per share. Rather than buying the share directly, you paid a conversion parity price of how much? Market conversion price of 40. How much have you paid extra? We have paid 10 rupee extra. So market price of equity share, if you deduct from market conversion price, which is conversion parity price of 40, you get 10 rupee of premium, right? Next is percentage of premium. So how much is 10 as a percentage of present market price of 30? So 10 divided by 30 gives me 33% as the mark conversion premium in percentage terms. Next, let's do the F part first. Favorable income differential. Sir, how much is the amount of income that you receive? First from debenture on a per share basis, then dividend on a per share basis. Dividend on a per share basis is rupee 1 only. How much is the debenture on per share basis? 9% into 1000 rupee give me 90 rupee of income. Against 25 shares give me 3.6 rupee of coupon I will receive on a per share basis. So how much is the favorable income being generated? 3.6 minus 1 give me 2.6 as the favorable income generated per share, which you can say coupon per share minus dividend per share. Simply you may not use the formula which is at present given. You can simply use the formula coupon per share minus debenture per share, dividend per share give me 2.6. So how much is the premium payback period? You paid 10 rupee on that share extra, right, to purchase it. As compared to purchasing it directly, you went through the debenture route where you paid 10 rupee extra, where if you realize 2.6 extra, so 10 divided by 2.6 give me 3.85 years for you to recover that value of 3.8 10 rupee, recover that value of 10 extra paid, it takes you 3.85 years. Sir, except for part E, which I have not explained yet, everything else is a 10 on 10 clear to you. Could you all feel the application of those learnings at the OutNotes can happen here in the OutScanner? Come on, what do you say? Could you all feel that? Everyone requesting your response? What do you say? The objective is not to be able to only do the practical concepts or only do the practical question. Doing the question such that we can feel it to be the application of the concept is the main thing, obviously, after having the conceptual clarity. Sir, premium over straight value of the debenture is what? It is Right now in the market price is 1000, over and above 100. How much is it extra that people are ready to pay? 200 rupee in percentage terms. It as a base of 800, it become 25%, and 200 as a base of 1000, which is at CMP, it become 20%. You do both in the exam, right? One is 25%, another is 20%. Sorted? Sir, this completes the question on the conversion, and this completes the entire discussion, everyone, on the chapter of bond. Now we have to go to money market security, which is a less effort taking thing you have to do. Maybe in the next 30 minutes, we should be able to do the entire thing. Yes, boss? Come on, come on, come on. Yes. Just next 30 minutes, and we should be able to do the entire thing. That easy actually money market part is. Shall we proceed? From practical question point of view, you have to understand that money market securities will include these four security: commercial bill, treasury bill, commercial paper, certificate of deposit. And along with that, there is one more concept that you have to learn: repo and reverse repo. In these four different securities, fortunately, there are just two calculations involved, which are common in four of them. But before that, let's understand the basic structure and the cash flows and a basic thing about it, about these securities. Sir, first of all, you have to know that treasury bill are issued by government, commercial paper are issued by companies with good credit ratings, and certificate of deposits are issued by banks. All three of securities are exactly same as bond, a zero coupon bond. When a company needs to borrow money, it issues the security. When I issue the security, I issue them at a issue price. There is no interest rate on this bond. They are all redeemed at their face value. So whenever it comes to redemption, I make the repayment of the borrowing and I redeem it at face value. So obviously the price which will be the issue price of the bond will be at discount, similar to zero coupon bond. So there are just two cash flow involved. As an investor, one outflow initially of issue price and one ultimately inflow of face value, and the difference between the two is my income. The difference between the two is the cost to the issuer. When a company issues the bond at 98, issues a commercial paper at 90 and redeems it at 100, 2 rupee is what my earning, 2 rupee is what companies cost us. Same goes for treasury bills, same goes for certificate of officer. This is how the structure of the security is. Commercial bill, on the other hand, is that bill of exchange, that discounted bill of exchange, for which even if we don't understand the underlying meaning, the structure of the cash flow, the nature of cash flow and the structure of the security remain the same. Issued at discount, redeemed at par. Basic clear? Now let me give you a clarification. Now to what I explained. There is a possibility that what you learn now may be different from your previous learnings or what has institute done. But I can commit that what I teach you now is going to be way more easier than your previous learnings. And without compromise of marks, you can solve all the questions with the simplest formula that I give you. Now let's learn. Suppose you invest in a security at rupee 98. So one more thing. After a security is issued, it gets traded in the market at its current market price. Yes, sir. The current market price, everyone in the class can become with from 98, it can over the time can become 99 or 99.5 or whatever, and ultimately the bond is redeemed at face value. So it may happen that I may not purchase a money market instrument here and I may purchase it here, which is all fine, does not matter. Cool. Now, suppose you purchase the bond at the time of issue price of 98. You purchase a treasury bill, I mean to say, which gets redeemed on rupee at rupee 100 on its face value after 3 months. If I ask you how much is the amount of income you have earned, can I say you will say 100 minus 98 is equal to rupee 2 of income? Yes or no? You will say, sir, 2 rupee income is what I've earned, right? Right. Now you tell me, people, in percentage terms, how much is your income? So the basic logic that you will say is that 2 rupee earned in the numerator against an investment of 98 I've made. So in the numerator comes what I earn and in the denominator comes what I pay for it. So 2 divided by 98 is the return you have made, agreed. That is one particular type of return which is called as add-on yield. What is that return called as add-on yield? One more type of return that you have to calculate is called as discount rate or discount yield, which is 2 divided by 100. It is 2 rupee of income being earned because it is 2 rupee of discount being given. What are you earning as your income is amount of discount? A face value of the security is 100. If it is issued at 96, isn't it 2 rupee of discount you have earned? Yes. So calling that 2 rupee of income to be the discount, right? And that is always as a percentage of face value. Discount is calculated as a percentage of what? Face value. So that 2% that you calculate is called as discount rate or discount yield, unlike 2 divided by 98, which was add-on yield. The two variations of return calculation, is it clear to you all, boss? Yes. Now you learn it. Sir, please pay attention. This was, suppose the holding period of my security was 3 months. So do you agree this 2% or this 2.04%, whatever you get, you could earn this much in a period of 3 months? So how much will be the return per annum? Please remember, unless otherwise specifically said, we have to always do the annualization of return in a simple interest based manner, no compounding, similar to mutual fund. Sir, if 3% is the return, if 2% is the return for holding period, then for the year it is 12 divided by 2 or 360 divided by whatever number of days. Simple annualization, point of learning number one, you have to annualize it particularly using 360 days if it is discount yield. In your entire AFM, there are only three places where you use 360 day. One is this discount yield in money market. Another is FRA, instrument forward trade agreement of IRRM. Third is generic swap of IRRM, which is swap section, swap topic of IRRM. At these three places in your entire AFM, you consider 360 days if the question is silent. Everywhere else is 365. So if it is a discount rate, formula is really clear. Redemption value of 1000 minus the issue price or CMP of 98 divided by redemption value, which is face value of 1000, give me 2%. But for the entire year, it is 12 divided by 3, which is 8%. Logic? Agreed. Similarly, the way I have to annualize an add-on yield is same. Sir, first of all, say 100 minus 98, which is redemption value minus the issue price, divided by 98 being my issue price, annualizing it simply with 12 divided by n, or 365 this time. Add-on yield is 365 day best divided by n, if it is number of days. Sir, why here is 360, here is 365? That is a market convention which is going on for years, and that is now what being is followed. Sir, let me take you to a practical question, which is everyone in the class. Take an easy question, let's say an easy question, which is question number 49. A brilliant question, question number 49. What it says? It says that a money market instrument which has a face value of rupee 100 and discount yield of 6% will mature in 45 days. You are required to calculate the current market price. Before I make you people do this question, listen to a line that I say. Can I say discount yield? The annual discount yield is simply redemption value minus issue price divided by redemption value into 12 divided by n, or 360 divided by n. How many variables are there in the formula? One, the discount yield. Second, the redemption value. Third, the issue price. Four, the n. Correct? Similarly, if it is the formula of annual add-on yield, can I say formula will be annual add-on yield is equal to redemption value minus issue price divided by issue price, whole multiplied by 12 or 365 divided by n. How many variables are there in this particular formula? Add-on yield, redemption value, issue price, n, the four variables. In both of these formulas, people in the class, if any three out of the four variables are given, can you calculate the fourth one for me? Requesting your responses. Most important line of this entire topic, which is where we particularly deviate from institute. We don't learn three different formulas to calculate three different things. We use the same formula to reverse calculate any fourth thing that the institute want us to explain. Sir, if you give us these three variable, I'll calculate discount yield. If you give me discount yield redemption value, I can calculate the issue price using same formula. If you give me issue price as well, I'll back calculate the n using the same formula. Requesting your responses, everyone. The same goes with the add-on yield, and which is why we differentiate with the presentation, not just in CFA, that goes to even my CFA students in that case. Same formula. Final answer matching. At the end of step, the answer will match. You won't, face any deduction of marks. If your answer is correct, you will get the marks, and that's how we have to solve question number 49. A quick timeline imagination, bond with face value 100, maturity of 45 days, has some issue price which we don't know. If the discount yield people in the class is 6%, needless to mention per annum, how much is it's the CMP, which is my number here. So I know 100 minus CMP divided by 100, because it is a discount yield, into 360 divided by 45 into 100 is equal to 6, right? Please see. 6 is equal to 100 minus CMP divided by 100 into 360 by 45. In this entire equation, only one number is missing, CMP. How do you calculate that? I'm not going to teach you right now. But do you agree? 99.25%. For using this equation, if you solve CMP, it becomes 99.25 pp. Next, what is bond equivalent yield? You know what is the best part now? There are 5 to 6 names of add-on yield. You can also call it to be money market yield. You can also call it to be bond equivalent yield. You can also call it to be interest rate, or only yield, or investment rate. Meaning to say, anything except a discount yield, if they speak, assume it to be the add-on yield, this one. Anything except a discount yield is this one. And in this yield, there are two ways to calculate. One is simple annualized and one is compounded annualized. We have learned simple annualized. Let's first solve the question for bond equivalent. Sir, if I have now 99.25 at this price, 100 as this price, time being 45 days, can I calculate the add-on yield? 100 minus 99.25 divided by 99.25 into 365 this time divided by 45 into 100, give me the final answer as 6.13% on a rounded off basis. Is this concept of bond equivalent yield done? Now you learn this concept, and after solving this question, we will have the last concept of this entire video, which is a brilliant and very easily explained concept. We have, everyone in the class, the effective yield calculation now. Boss, ready are we all with me there to calculate the effective yield? You learned that 2 divided by 98 is how much? 2 is the amount of income you earned, divided by 98 gives me 2.04% is the return you make over a period of 3 months. If I ask you to annualize it, you will do 12 divided by 3, which is a simple annualization without any compounding effect. But in the real world, it will be 2.04% compounded 4 times in a year. Because every time you invest, you get the income, you earn interest on interest, interest on income. Then in the next time, you earn more interest. So further, if you invest, you will invest that received interest also. Can you feel in the actual world you will earn the amount with compounding effect? Correct. Requesting your responses, everyone. Could you connect what I'm trying to explain? You invest 98 here, you get 100 here. So if you get 100 here, you will earn your next income of 2.04% on this 100, which includes 2 rupee of income earned in the previous case, which is interest on interest, which is compounding. So you have to calculate the effective annual yield with the compounding effect. You will say 1 plus 2.04% will be compounding 4 times in a year. How did I get 4? Sir, 12 months in a year divided by every compounding if it happens in 3 months. So you will have 4 compounding. Similarly, there are 365 days in a year. One period is 45 days. So 365 divided by 45 gives you 8.11 times of compounding. Minus 1 people in the class give me the effective annual yield. So you minus 1 because you added it here. For the purpose of compounding, you did add, and accordingly, if I have to calculate the effective annual return, I'll be like, holding period return is how much? 100 minus 99.25 divided by 99.25. 99.25 divided by 99.25 give me point into 100 give me 0.756%. This you earn in 45 days. So how much will you earn in 365 days? Sir, please remember, add-on yield is 365 day based only, whether it is simple annualization or compounded annualization, it is 365 days only. So I will say 0.756% is the return of 45 days. So 1 plus this return, how many such compounding will happen in a year? 365 divided by 45. Minus 1 give me the compounded annual rate of return. Sir, how do I calculate it? Dirty power. Please respond to me. Do you want me to teach you dirty power or you already know it? Come on. Your response will actually help me to understand what do I have to do. So please tell me. Waiting for your responses. You said yes. Is it that you want me to teach you it? Bhagya, was that yes for this? So very simple, very simple. I'll teach you. Sir, there's a very simple calci shortcut. When you feel that the number is really awkward, it's not possible to solve it normally with your basic mathematical things. So how do you to solve it? You have to take this number here, right? What is 1.00765? The number for which you have to do the dirty power, you have to take it on a calci. Then you have to press under root 12 times. 1, 2, 3, 4, 5, 6, 7, 8, 9, 12. After pressing under root 12 times, deduct 1 from it. Basically, eliminate this 1 minus 1. Then to this number, you simply multiply your power. What is your power? Sir, into 365 divided by 45 is your power. Have you done it? Then you add back 1 again. So adding 1 again to it because we deducted. And now you do the reverse of under root. Pressing under root is to be reversed, which means you have to press into equal to 12 times. So plus 1 if you have done, then into equal to 1 time, into equal to 2 times, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Give me 1.2804. 1.2804 I'm getting, which is obviously a wrong number. It cannot be 28%. So give me a second. 1.00765. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Minus 1 into 365 divided by 45 plus 1 into equal to 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. 1.6376 something 1 point. Actually, you're getting the answer, Nilesh. 1.06299. 1.06299. If you're getting the answer, then obviously this is how the dirty power is to be done. This minus 1 gives you the rate, gives you 6.299, 0.06299 or 6.299% or 6.63% is the answer of effective annual return, which is simply the add-on yield with compounding effect. Bhag, you have got it as well. So everyone else in the class, we have done that discussion with that we initially avoided in the realized yield. This dirty power avoid calculation we avoided in the realized yield is now finally done. So effective formula to be applied only when question asks effective discount yield, formula to be applied only when the question asks you discount yield. Everything else people in the class said add-on yield. Whenever examiner asks you to calculate yield, needless to mention, you have to calculate annualized yield, not only the holding period yield, because return that we calculate is always annualized. Boss, in these four securities, the same logic you have to apply. In the same single question, we have applied all three formulas. Are you all connected to me on this? Requesting your responses. Question number 49. Are you all 10 on 10 connected to me on this? Please tell me. There are more A category question on this. For example, 51 question is a A category question, which is a good question. Similarly, 48 is A category question, but since there is a small point of difference, there's no point of doing all the questions in the class. Our main objective of this revision video is to make sure we do all the concepts and do one question of each concept from applicability point of view, right? 52nd question, the last question of this video, can be done after learning this super logical concept of repo and reverse repo. And the way we are going to learn it in the class is going to make the concept really, really easy for you. Ready are we for the last thing? Come on. How are the energies, by the way? By the point we have come to the end of 5th hour in this video. How are the energies, everyone? My God, what is more there? The tiredness of doing so much or the satisfaction of doing so much? Everyone, what do you say? What's there right now? Obviously, the satisfaction of doing so much things is dominating our tiredness, which is there in our body, but in our emotion is that yes, we have done everything. Yeah, I can understand tiredness there, 100% is there. Satisfaction will continue till exam. Tiredness can be gone after 1 to 2 hours of sleep after this video. Yes, that's simple the point is. So come on, everyone in the class, last thing for the day, let's do it really well. Sir, repo and reverse repo is a simple transaction where if I am a bank, I want to borrow an amount. If I want to, if I want to borrow an amount, I will sell some securities to RBI. Sir, is it selling the security to the RBI? Actually, it is a type of collateral being given to RBI. When I borrow from someone, I have to give something in the form of collateral, in the form of security deposit. Yes, exactly the same way. I will give some securities in the form of collateral to RBI, but that we consider as a sale to RBI. And when I sell those securities to RBI, RBI lends me an amount, and that is the borrowing which is happening. But now the more detailed step-by story, right? First, when I sell the bonds, sell the assets to the RBI, what is exactly that asset that I sell to RBI? They are Government of India bonds, right? The bond from the highest level, the best bonds that in India is Government of India bond. So when I sell those bonds to RBI, RBI gives me a price based on the market price of that bond. So I went to the market to check what is its market price. And do you people agree? I taught you in the class today that bonds are quoted in the market at their flat price. Yes or no? The clean price is the price at which the bond is quoted. And when I sell the bond to anyone, the other party needs to pay me an amount not equal to the clean price but dirty price, because he pays to me the total amount against that bond. Yes, sir. So if the flat price is given, can I add accrued coupon to it and find out the dirty or the full price of the bond? Which means logically, when a bank sells a bond to the RBI, the RBI should pay to me a dirty price. Logical? Yes. But now you tell me one more thing. Suppose the flat price was 95 plus 3 rupee of accrued coupon make the dirty price to be 98. When you give to another bank a security worth rupee 98, will the other party give you a loan of 98 or will deduct something in the form of security? Will keep some margin with itself and give you a loan of, for example, say only rupee 94. So that deduction of 4 rupee, people, is called as repo margin, is called as initial margin, is called as haircut. That whatever amount, whatever value of security you give to RBI, RBI will deduct a repo margin or haircut and then give you only some balance of the amount in the form of borrowing. So today when you sell the security to RBI, right, RBI give the amount of loan. And today, along with that borrowing, you enter into an agreement with RBI called as repurchase agreement, saying him that RBI, the securities that I'm selling you right now, against which you are giving me an amount today, I will buy those securities back on a later date and I will make the repayment of the borrowing, and then you sell those securities back to me. So I will buy the securities back and I'll make the repayment of the amount. And what is the amount being repaid is simply what is the amount you borrow, the amount of your borrowing into 1 plus whatever is the rate for a period of time. For example, 5% is the rate and the period of borrowing is 30 days. So 30 divided by 360 into 5%, 1 plus the borrowing amount will give you the repayment amount called as repurchase price. Everyone? So it looks like selling the security today and buying it back on a later date, but effectively it is borrowing an amount today and repaying it along with the interest on a later date. The amount of borrowing today depends on the price of the security which is sold to RBI, but the amount of repayment does not depends on the price of that day. It depends on the amount I borrowed multiplied with the interest rate for whatever time period. The terminology that you should be comfortable about is first the period for which the repo happens, the period for which the borrowing happens called as repo rate. The rate, sorry, called as repo term repo duration. The rate at which the interest will be charged by RBI to us when we go to repayment is repo rate at which the borrowings are made, right? Then the concept of clean plus accrued is equal to dirty. From the dirty, you have to deduct the repo margin. Then you get the amount of borrowing, which is also called as first leg, which is also called as a start proceed, to which if you add interest for n period, you get the second leg or amount of repayment or maturity proceed. Is the concept 10 out of 10 clear to every single student sitting here? Please. So just three calculation involved. One, flat to dirty, another dirty to borrowing, third borrowing to repayment. That's all the question will get over. Yes, no? And if you are able to understand it with the clarity, let's solve this particular question, question number 52, asked in the attempt of Jain 26 in the form of MCQs. Come on. Sir, Bank A enters into repo for 14 days with Bank B in 10% government bond 2028 at the rate of 5.65% for rupee 8 crores. Wow. The main thing in this question, this particular question, is to be able to understand the question, then the solution itself. Bank enter into repo means bank will sell the security and get the loan for a period of 14 days. It takes it. What does it sell? 10% Government of India bond 2028, name of the security. So 10% is the coupon rate of that Government of India bond which will mature in 2028. What is the rate at which borrowing has been made by Bank A from Bank B? 5.85%. And what is 8 crore? The total, the most important interpretation, the total face value of the securities being sold. 8 crore is not the market value of security being sold, it is the face value of security being sold, assuming that clean price, which does not have the accrued interest, we know is 99.42. Initial margin is 2% and the accrued interest is for 262 days. You are required to calculate dirty price. Is that simple? Sir, assuming 360 days, can I say if the market price of the bond is 99.42, then face value of 100 is the best assumption? So face value in the coupon rate of 10% into 262 divided by 360 gives me the amount of accrued coupon. So 100 into 10% into 260 divided by 360 give me accrued coupon. And to the clean price of 99.42, when I add this accrued coupon, I get the dirty price of 106.70. Everyone in the class aligned to me? Yes or no? Tell me. Come on. Every security whose face value is 100 has a market price, dirty market price of 106.7. So when I sell you the security is worth rupee, having a face value of 8 crore, how much is the amount of market value of security that I sell you? Sir, how many bonds do I have? 8 crore divided by 100 being the face value of per bond, give me 8 lakh number of bond. So 106.7 is the dirty price of every bond into 8 lakh bond give me 8 crore 53 lakh 60,000 as the total dirty price of all the bonds that I have sold you. 853 60,000. When I sell you these bonds, you don't pay me the entire amount. You pay me after deduction of 2%. So minus 2% give me 836.52 800, which is the amount of start proceed, the borrowing amount, which is my first leg. So first we calculated the dirty price of every bond, part A. Second, the borrowing amount is 8 crore 36 lakh 52 800. Let's put it to M plus. Now the repayment is how much, sir? After 14 days, at the rate of 5.65, how much interest will you pay? 0.0565. 0.0565 into 14 divided by 360 plus 1 into the borrowing. So 1 plus Rn into the present value give me future value 838 36603. 838 36603.79, which is 36604, is the amount of repayment. You can, if you want, manually add interest, present value into principal into rate into time, will give you the future value. What I've done is present value into 1 plus Rn is equal to future value. Sir, sometimes you do present value into 1 plus r to the power n is equal to future value. Yes, this is without compounding effect. This is with compounding effect. In repo, you don't do any compounding. It is simply 1 plus rn, rate into time, simple interest effect is equal to future value. Could you all, everyone in the class, connect to me on this particular question? Is this particular question and the concept number is this particular concept in question number 52 10 on 10 clear to every single student sitting in the class? So that everyone in the class really marks the end of this video, which where, let me tell you, we have really put in the best efforts, tried to understand every possible concept with its best effort, trying to also teach you the practical question tips, the way to remember the things, the underlying background, the important pointers, the presentation tips. Then we have also solved the questions, and not that we just solve the questions separately. Try to solve the questions as that you can feel the applicability of concepts so that you don't have to mug up the things. That was everything on fixed income securities, boss. As I said, if you people really liked this video, kindly share your feedback, live and recorded people, in the comment section. It does motivate me. Yes. So let's meet back again in the next video. Till then, bye bye. I'll see you all. Thank you so much, everyone. Yes, boss. So thank you so much. A special thanks to all the live people sitting here right from the start till the end. I appreciate you have done a great job. And believe me, trust me, you will feel relaxed, satisfied on the exam day during that last few days of the exam days that you made those efforts. Yes, so great. See you all in the next one. Mutual fund, I will try. Bhagya, I'm not committing. Thank you, guys. Thank you so much. I'll see you all. Bye. Take care. Bye, guys.